Hey, there we go. There we go. Hang on. Let me fix this bad boy. Let me put myself on speaker. There we go. Cool. Awesome. All right. So we're starting what are we in February right now? Yes. Our second Closers College of 2022. We've got anywhere from 60 to 75 people right now logged in, getting our training. And we've got Brandon Reed, who represents a company called Heartland Financial. Heartland Financial is one of our preferred vendors that we offer hospital indemnity plans. A lot of you guys are probably asking, what in the world does this have to do with life insurance? And so I want you to diligently take notes today, because I'm going to tell you, in my personal practice, I sell a lot of cash accumulation IUL. I sell a lot of term life insurance with full living benefits. And then as a gap to the waiting period that living benefits have, I sell hospital indemnity. Brandon has had the pleasure of working in this company for a few years, worked side by side with the founder and owner of the company of the individual that created this product. So Brandon, I'm gonna give you the floor, my brother. I appreciate your time and energy. I love that you're here on a Saturday to help develop these guys. The floor is yours, my friend.
Absolutely. Thank you, Tony. I'm glad to be here. And thanks everyone for taking some time out of your Saturdays as well. This is an exciting product. It's a product that I've been working with for over 3 years now. Definitely blessed to have been working in the corner of our Director of Operations office for quite some time, giving me access to a lot of knowledge. And really, 3 years doesn't sound like a ton in this industry, but it depends on who you've been working with, right? If you've got a great leader like Tony or a good leader like Nick Micheletti, those 3 years could be worth 20 plus years for someone else. So definitely happy to be on. And as Tony mentioned, this is a great product. No matter what you're currently selling, if it's life insurance or under 65 health, this product is designed to fill in the gaps for people's health costs. So we'll get started. The company name is Heartland National Life Insurance Company. We're based out of Blue Springs, Missouri. So for a little backstory on me, I'm actually originally from Toronto, Canada. I moved down here about 8 years ago to play college baseball. And I was a pitcher in college. Met my wife my junior year. We ended up getting married right out of college, and I found myself in this wonderful industry. So that's a little bit about me. I could get into the story about how I ended up making that decision, but we'll save that for another time. Hope to meet everyone here on the call someday soon in person. And Tony, again, thank you for having me. So why hospital indemnity? Why sell it? The real reason, for you, the agent, is to generate more income, right? It's a great opportunity for new income. The commissions pay on issuance of the policy. And what you like about this is, similar to life insurance, it does pay on an advancing schedule. So it pays a 9-month advance on the issuance of the policy. So if your policy was written today, February 26th, that policy will likely pay here probably Tuesday or Wednesday of this upcoming week at a 9-month advance. We'll go over some commission examples a little bit later, but first I want to explain why it's so important and what this does for your clients. This policy helps protect your clients from out-of-pocket exposure, whether it be under 65, over 65, or a life client on maybe an employer plan through their work. It's affordable. This policy doesn't cost a lot for what it gives back to your client and puts in their pockets. The policy is simplified issue, meaning it doesn't go through an underwriting process. There's no phone interviews. There's no saliva tests. This is a simplified issue policy, meaning if you submit an application today, and as long as you've done a good job field underwriting it as the agent, the policy will be issued as long as all the answers on the question, the health questions, were answered no. The policy also has a guaranteed issue period, which you'll like. The guaranteed issue period is more designed around the over 65 market when people age into Medicare, 64 and a half to 65 and a half. That way, those individuals aren't restricted to getting on a plan if they have health issues. What you'll also see, a benefit to you, the agent, is this policy, layering these and stacking these indemnity plans on your current book of business, helps increase persistency, right? So what do I mean by that? Well, persistency is simply keeping members, yours, keeping them on your book. So by having one policy with a client, some people might say there's an 80–90% chance that person could cancel and move to another agent. Well, with having two policies with an individual, that actually goes down to about 50% lapse. Once you start layering things, let's say life insurance, major medical, and a hospital indemnity plan, you're then looking at maybe a 10% lapse rate, because that person's coming to you with all their questions, whether it's life insurance, health, you name it. So that person's not calling into 1-800 numbers that they're seeing on TV. They're not calling other people. They're calling you for everything. And that helps, make you that person that they go to for their insurance. Plan was designed more so around the Medicare space, but it's a wonderful fit for under 65 as well. So today I've customized this presentation to fit into our under 65 space, whether we're dealing with major medical, ACA, or short-term medical plans. Short-term medical plans is where I work in the under 65 space myself. I am a licensed agent, so I do sell on the weekends and in the the majority of my business is over 65. However, I do have quite a few referrals in the under 65 space, and I write short-term medical insurance with big deductibles and co-insurances that obviously we need to fill. So whether you're dealing with someone on a major medical plan or ACA, we need to look at that current health plan. When we're looking at building a hospital indemnity plan around their current situation, we need to review that plan. Okay, we need to identify what co-pays they're subject to, co-insurances and deductibles. Under 65 deductibles are pretty common. I had a plan for years with Blue Cross Blue Shield through the employer. I had a $3,000 deductible. So if I'm hospitalized, I'm paying 100% out of pocket until I meet that deductible, which is why we need something to help, fill in the gaps with our health costs. So you'll also see, doesn't matter what market you're working in, there's always going to be exposure when we start talking about cancer, right? So these plans have cancer benefits that you can add on, and it's cheap. I'll tell you that it's affordable. You're probably doing it with some standalone cancer plans right now, critical illness. But what we'll see here with Heartland National is you can add on a little cancer rider and help protect them from the unexpected, right? Costs related to cancer. We all know, it's not just hospital costs when we get diagnosed with cancer. It's not just MRIs and CT scans. It's actually more so the RX costs, right? Your prescription costs jump. You start taking all sorts of brand name medications, drugs to fight cancer. We'd start looking at experimental treatment like stem cell transplants. We look at chemotherapy, things that cost a lot out of pocket. And if you've got a big deductible on your health plan, we need to be able to help that individual on the diagnosis of cancer to protect them from the unexpected. Then next up, we obviously need to know how to work our quoting tool. So I'll do a quick demonstration of how to work our quoting tool today, and we'll demo the Secure Advantage Flex Plans e-application. What you'll like to see is our e-app definitely makes it easy to use over the phone. We do have a text and email signature option for your clients. So we are currently now in 36 states. We stay out of the Northeast. It's tough to get insurance companies up there and launch products. Same thing with California. So you'll see we do make up most of the map, but we're limited right now to 36 of the states, including Texas. I'm going to pause real quick, see if we've got any questions in the chat box.
Yeah. So let me ask some of the questions that are here. Guys, you're free to ask questions on the chat box. And what I'll do is when he gives a break, I'll actually ask them, just so you guys know. So I apologize. The way I typed it up in the beginning was as though I wanted you to ask afterwards. Feel free to ask throughout the entire time, and then I'll go ahead and ask them when he gives me a break here. All right. So here's a question here. I got someone here who has a friend who's a paraplegic and has been for a few years. Is there any type of plan out there for him?
So a paraplegic, so under 65 on disability.
Yeah.
We'd want to, so I'll go through the underwriting questions towards the end of the presentation. We'll look through all those questions, but there's a series of about 6 health questions, and question one has section A through H. So we'll go through some health questions a little bit later, depending on the health of that client.
Gotcha.
We'll go ahead and identify if they'll qualify or not.
Can you do me a favor as well too, if you can, please?
Yes.
Show me the states that are available so I can take a screenshot of that. I think
Perfect.
I'm gonna add it to our website.
Okay, great.
Thank you so much. And bam, I got it. That works.
Okay.
Thank you, sir.
Thanks, Tony.
Would people with ITINs be included this year? I know that you guys were working on that. Nick said you guys are working on getting ITINs to be accessible to this. Is that something you have a date on?
ITINs as in like a TENS unit?
ITIN as in a non-resident alien.
Oh, I got you.
Social security number.
Yeah, right now you do have to have a social. Nick might be working that on behind the scenes, but I'll check in with him for sure to get some progress, and we can kick an email over to you, Tony, with an update once we've made that available. But right now we have to have a social security number. So for example, myself, I'm on a green card, not a citizen yet, but I'm a permanent resident. So I do have a social, and you would need one on the application.
Gotcha. Okay. Thanks so much. I appreciate that.
Okay. Good. So we'll get into the benefits. We'll start with the base plan, and then we'll dive into some of the highlights, like our household discount and our guaranteed issue. So this plan is flexible. That's why it's called the Secure Advantage Flex Hospital Indemnity Plan. This plan is designed with a hospital benefit, a daily benefit ranging from $100 a day to $600 a day in benefit. So us working to cover something like a deductible, we'd probably be maxing that puppy out and looking to protect someone from the average hospital stay, which is what, Tony, probably right around 2 or 3 days before they start trying to kick you out. So this plan covers both accident and illness. So it's not limited to just accident, like you might see with some competitors, like an accident plan. So this plan ranges from 3 to 10 days in benefit, 15, 20, or 31 days. We'll see that this benefit also pays on observation up to 3 days per year. So that's a big one, everyone. This benefit not only pays on a hospital confinement, but if you're put in observation, let's say even for 12 hours, this benefit will actually pay 100% of your confinement amount just for a 12-hour observation stay. Now, if we're wanting to get a hospital benefit paid on an admission, we need to be in the hospital for a full 24 hours before that, let's say, $500, $600 a day benefit will pay. Okay. The ER benefit is built in. So we're going to get into how to actually sell this plan in a minute. We could talk about benefits all day long, but we actually want to, get into the sales side of it. So when we're doing that, this comes into play, and it actually really helps you create a lot of value in what you're putting together for them in the package. So that's built in, right? Whether it's $30 a month for your hospital plan, $50 a month, depending on how much you load it up with, that $150 ER benefit is going to be built in. So now we're covering them for 2 things rather than just one for that same premium. And that ER benefit pays 4 times a year. It's not contingent on hospital admission. So even if you're not admitted to the hospital, let's say you go to the ER and they send you home. Well, here comes $150 ER benefit. All you have to do is submit the itemized bill, or also known as a UB-04 form. So we'll get into the claims process towards the end of the call, but you're going to like it. It's a very easy claims process. There's not an actual claims form. All Heartland needs is a copy of their bill faxed in to customer service or claims. It's the same fax number. Okay. This hospital benefit up top actually restores every 60 days. The reason for that restoration is with over 65 with Medicare, hospital copays restore and deductibles restore every 60 days. So that's why we've done that. And it's actually going to benefit your under 65 clients as well. Even if they've already satisfied their deductible. Hey, there's no coordination of benefits here. This is an indemnity policy, meaning we pay you cash. You're hospitalized for 3 days. We pay you your cash benefit for those 3 days. 60 days goes by, you've used up your 3-day benefit. Well, guess what? Here comes another 3-day payment for that next hospitalization 61 days later. So you might be making money at that point if you've already covered everything you needed to on your health plan. Okay. Any questions on that base plan, or are we good to move on over to the highlights.
Yeah, I got some questions. Number one,
Okay.
what is the turnaround? And then you might have answered that, so I apologize if I didn't capture it. What's the turnaround time from when they file the claim to when they receive the money?
Yeah, so we're going to get into that here when we start talking about the 6-month pre-ex and
Gotcha.
our 1-year contestability period. But typically, within 30 days, we'll get that claim paid out. Now, I will tell you, within the first year, we have what's called a 1-year contestability period. You'll see it all across the board on all hospital plans. Most actually enforce that for 2 years. We typically only enforce that for 1. So it's a 1-year contestability period, meaning if you go ahead and let's say you submit an application for Mr. Jones, you say, no, he didn't have cancer within the last 5 years, at last 2 years, which is our look back for cancer on the base plan. Now, he goes and files a claim for a 3-day hospital stay, and he's expecting a $1,500 claim paid out. Well, we go back within the first year, we're able to pull medical records on that claim. So we can pull those on the beneficiary, and we find out maybe he did have cancer, and we answered that no, whereas we should have answered it yes. So the gentleman shouldn't have qualified for the program. Well, within that first year, we can actually decline the payment and reimburse him his premiums that he's paid into the plan up to this point. So within that first year, the reason I bring that up is we might be pulling medical records, right? In a scenario like that. So it could take a little bit longer within the first year. But outside the first year, I guarantee that claim will be paid within 30 days.
Gotcha. A couple other questions that are here. You don't have anything for Wisconsin, it looks like. Is Wisconsin soon to be?
We're not in Wisconsin.
Okay.
I wouldn't say soon to be. That's probably similar to the getting other methods of, personal information accepted in form of the social security number, something that we look at with Nick.
Gotcha. So I do know this, guys, for Wisconsin, we're checking right now. I'm having Rob check right now to see if there's any other carriers that we have that do hospital indemnity for Wisconsin. Another question here. So does it have to be 12 hours for observation, or can it be less time?
Yeah, it could be less. That was just an example.
Gotcha.
The actual hospital confinement will have to be 24. Observation pays less than 24.
Gotcha. Okay.
Good question.
Will a client be dropped for excessive visits?
Well, if they qualify for this plan, they can use all the benefits they want. If, as long as they got on and they're, let's say they had a pre-existing condition, that pre-existing condition pre-ex is only in force for 6 months.
Gotcha. So basically after 6 months, they can go back in for
anything.
For anything. Okay. And then how does that 6-month waiting period from that 60-day restoration period, how do they work together or don't work together?
Yeah, they don't work together, but the 60-day restoration is strictly related to this hospital benefit up top here, the $100 to $600 a day,
Gotcha.
Days 3 to 10, 15, 20, or 31. So let's say, an individual uses up their 31-day benefit. They cash out, they file a claim, and then they're released from the hospital. 61 days later, they end up back in the hospital. They get a full another, if this is the benefit they selected here, 31 days, they get a whole another 31 days to use in the hospital.
As long as it's the same reason they're in.
It could be anything. It could be a new diagnosis. This is again just a cash benefit that restores every 60 days.
So the 6 month is just for pre-existing before claim.
Yep. Yeah. So let's go ahead and tackle some of the highlights over here, and I'll jump onto that 6-month pre-ex. The 6-month pre-ex relates to anything you were diagnosed with, treated for, or taking medication for within 6 months prior to purchasing the policy, right? So if we have, let's say, something minor, anemia, right? Low iron in the blood. And within the first 6 months on this plan, we're put in the hospital for something related to our anemia. It's a pre-existing condition. The hospital benefit won't pay for anything related to that, the low iron, if that's why you were put in the hospital. But anything else it would be paying for, let's say they slip and fall, sure, we'll pay within the first 6 months. If it's anything other than being related to their pre-existing condition. Now, you can't have a pre-existing condition that would disqualify you from the plan, such as a heart attack or cancer within the last 2 years, or a pacemaker or COPD, that's, the only way you're getting on a program with any of those conditions would be within our guaranteed issue period at 64.5 to 65.5. In that case, you get on the plan. You don't have to answer those medical questions to get this program. You still have the 6-month pre-X in force for those guaranteed issue individuals.
Even if
Was that clear?
they're past the 1-year right of contestability?
What was that, Tony?
Even if they're past the 1-year right of contestability for that heart attack issue?
So that heart attack individual would be getting on the plan guaranteed issue, and they wouldn't have any claims paid within the first 6 months for anything related to their heart attack. That's because that would be consistent of that 6-month pre-X. Okay, 7 months later, they're put into the hospital for something related to their heart attack. We're paying because they were guaranteed issue. They got on that plan. The only stuff we're not paying for is pre-existing conditions within the first 6 months.
But that's only for 64 to 65. So like, let's say a 40-year-old says no to the heart attack questionnaire. It's 1 year past the right of contestability, and then they get a heart attack. This won't cover.
So someone says no on the application, we approve them, but they did have a heart attack within the last couple of years?
Yeah, and then a year after the contestability period, they have a heart attack, they're in the hospital. Would it pay or
Yep.
not?
Yeah, so we usually only enforce that contestability for 1 year. Nick does have the ability to enforce it for 2. On paper, it's a 2-year contestability, but typically we only enforce it for 1. And in that scenario, you would get paid. You'd get paid your benefit.
Wow. Okay, gotcha.
Okay, try not to be, submitting business. Just do a good job field underwriting.
Of course.
Yeah, don't try to squeeze people through, but who shouldn't be on the plan.
Now,
Okay.
one more question. This is the technical side of me because I just want to make sure I know the ins and outs.
Yeah, no worries.
Let's say you're within that 1 year contestability. Let's say they answered no to the heart attack, but they did have a heart attack, right? So they lied about that piece. And then within that first year, they end up in the hospital, but the reason that they're in the hospital has nothing to do with their heart condition, right? It's a completely different situation. Heartland will then do a 1 year medical look back, and they
find out that they had a heart attack.
Yeah, will they approve the claim even though the claim has nothing to do with the heart issue?
No, we'd rescind it and refund their premiums. So at least they're getting their premiums back.
Gotcha.
But we'd be canceling the policy
Gotcha.
and not paying the claim.
Gotcha. One question here that Tanisha asked, how are outpatient services handled? Example, outpatient surgeries or treatments like blood transfusions.
Nice. Yeah, we actually have an outpatient surgery benefit we'll get into here. These are just the base plan features. We have 7 riders actually available in the state of Texas and in most states. So yeah, we're going to jump into those riders here in a minute. First things first, I just want to make sure everyone knows that this plan is available for those individuals between 18 and 85. If you find someone over 85, Aetna has a plan. It's not as rich in benefits. It's going to be more costly too, but it doesn't have all the bells and whistles that this one does or the flexibility. It goes up to age 90 or 89, I believe, if you ever need someone over that 85 range. Okay. And again, Tony's looking in to see if anyone's covering these types of benefits in the state of Wisconsin. I do have access to search some things like that as well. So I'll take some time after the call to do that. This household discount, everyone, is real easy to qualify for. As long as you live with someone over the age of 18, in most states, you get that 7% discount. There's a few states like Oklahoma, Illinois, Ohio, some of those states that are required to have 2 people apply for the policy to be qualified. But in most states, including Texas, all you have to do is live with someone over the age of 18 and you get a 7% discount. Okay. The policy is issue age rated and unisex rated, meaning if you buy this policy at 36 years old, and let's say 10 years later, we're 46 years old, we're still paying that 36-year-old rate. Okay. If rates are the same for males and females, so whether I'm a male or female, I'm paying the same rate. Simplified issue, as we talked about earlier, yes or no questions on the app. and will be issued as long as we answer no on all the questions. Again, on paper, we do have a 2-year look back contestability period. We typically only enforce that for 1. If there's a big, $20,000 cancer claim being filed, we're probably going to look back those 2 years that we are able to. But if it's something minor, Nick's just going to go ahead and have them look back the 1. But if it gets into big claims like that, 20,000, everything goes through Nick, passes by on his desk. Okay, if you have claims, questions, you can always reach out to myself and Nick as well. I will make sure everyone has our contact information. We talked about the 6-month pre-ex, again, looking back six months and enforced for 6 months. There is a dual application available. Nothing worse than having to do one application and then go back in and do another for the husband or wife. They do offer the ability to do a dual application, take 2 at the same time. And what's nice about Heartland, we have there's a $25 application fee, right? A processing fee, policy fee, you may call it. We actually waive that for the second applicant if you do them both on the same application. Easier for you, and it actually saves the clients $25. So only 1 app fee on a dual application rather than charging them both. So now let's jump into the riders, and then I'm gonna keep going for a little while, and then we'll open up for some more questions, because I think most questions will get answered as I go through a thorough, in-depth presentation. So this is my favorite rider. This is probably one of the most common riders being added to this plan, whether it's under 65 or over 65. This benefit ranges from $1,000 to $20,000 a year. And again, this is a lump sum cancer benefit, meaning this benefit pays on the diagnosis of cancer. Just like any other standalone cancer plan, this benefit pays on the diagnosis of cancer. There is a skin cancer benefit that pays 5%. Skin cancer is pretty common, so most companies don't actually pay anything on it. Heartland National pays 5%, a 5% benefit on skin cancer. We also pay a 25% benefit on what's called cancer in situ. Cancer in situ is non-invasive cancer. Cancer that has not spread in the body, but anything internal, any type of internal cancer, we pay 100% of the lump sum amount from $1,000 to $20,000 in benefit. Since we're going to be working mostly in the under 65 market, we're going to see this benefit is pretty affordable. I've got a quote plugged in a little bit later in the presentation where we're looking at a 36-year-old, 10,000 in cancer benefit. It's only $12 a month to add something like that onto their policy. So I've got some ways that, when I'm in the home sitting at the table or on the phone with a client, I have a good way to position that and make them see the value in this benefit as well. Similar to life insurance, which I'm sure you guys are all very familiar with. Lump sum hospital confinement is huge in the under 65 space. This is a benefit that gets very expensive when we get, creep up over 65. So it's not something I sell much of over 65, but, working with an under 65 client, we're loading this benefit up. It's a lot more affordable. This benefit ranges from $500 up to $2,500 in lump sum. Okay, the lump sum benefit pays twice a year on one 24-hour period in the hospital. So all we have to do is be hospitalized for 1 full day, 1 24-hour admission, and we'll receive our lump sum amount, whether it be $500, $1,500, or $2,500. That's in addition to our base plan, right? If we've got a $500 daily benefit, back on the previous slide, that maybe we're paying, $20, $25 for, and then we add on a $2,500 lump sum. Now we're leaving for just a 1 day in the hospital. We're leaving with $3,000 cash in your pocket. Whether that's being used to pay for our deductible, if our deductible's already been met, then this is just cash in your pocket. You can put it in the bank. Again, this is an indemnity plan. It pays your client directly. We have an outpatient surgery benefit. So we had a question come up earlier. If your bill is considered outpatient surgery, so that's how the coding is on their UB04 or their itemized bill, we will pay up to $1,000 per procedure for an outpatient surgery. If you have a $200 copay for an outpatient surgery, for example, and we have a $500 outpatient surgery benefit selected on our plan. We're going to be billed for our 200 from our health plan, and you're going to get your $500 benefit from Heartland. Doesn't matter if it's, if you're being billed for that much, this benefit pays based on what you're paying for each month. No coordination of benefits. Okay. Skilled nursing is something more designed for your elderly. This is something where, you break a leg or you need 24-hour care 7 days a week. Doctor prescribes it. You'll see over 65 with Medicare. Medicare covers the first 20 days in skilled nursing. That's why this benefit here is designed to cover days 21 through 100, which is where you'll see costs over 65. It is something you can position under 65, but again, like I said, these top 3 benefits here are probably, going to be more popular for your under 65 folks. That's a benefit that pays per day, $150 or $200 a day in skilled nursing. Just because we're 36 years old now doesn't mean, we're always going to be 36. One day we will be over 65, and there's going to be some exposure in this category. So why not lock in a policy, for $7 a month instead of $17 a month when we're older? So you can lock that benefit in now and continue to be paid those benefits for the lifetime of the policy. Any questions on these core benefits here, these 4 riders, before I move on to the last 3?
I'll make a statement and then I'll ask a couple of these questions that these guys have asked to see if you can answer them. I'm big, guys, on selling the first and the second one, the lump sum cancer benefit, because it's not that big of an increase in price. But the main one I always sell is that lump sum hospital confinement. I max it out to $2,500. So when you look at it, you max it out to $2,500 and you give them a $600 daily benefit. If they just spend one night in the hospital, it's $3,100 that they're going to get in cash. And then the second day is another $600, and then the third day is another $600. But those 2 are huge that I add into the plan. And then when Brian is done here, I'll show you how I actually present it as well too. Here's some of the questions. Let me see here. Outpatient, I think, was already answered. I think I know the answer to this, but I'm going to ask it anyway. Elective surgery, is this covered? Because I know pregnancy is not covered unless it's a high risk pregnancy.
Emergency, like an emergency C-section would be covered, but
Gotcha.
nothing related to pregnancy.
Elective surgery is not covered.
If it's an outpatient surgery, as long as it's coded under outpatient, and they're choosing to have it like what's one we could think of, like a
BBL
cataract surgery, it would be covered. Yes, as long as it's coded under outpatient surgery, we'll pay. Yep.
Nice. So plastic surgery, if it's outpatient, will be covered.
Let me get back to you on plastic surgery. Is that what Hope just mentioned? Plastic surgery. I can run that down and see if it's a covered.
Yeah, I was just curious if you can.
Okay, I can do that. Any other questions, Tony?
Let me see here. What if the child is not 18 yet? So this is a question in reference to the household discount. If the child's 17 and then turns 18 and the policy is already enforced, does the discount apply when the kid turns 18?
Yeah, so if you've got someone over 18 on a policy and they live with someone who's 17 of age, once they turn 18, they can then have that added. We'd have to call into customer service and let them know that we're wanting to add the household discount at that point. They won't know, they won't know that you're living with someone who's 17 and just automatically apply it. So you do have to let the team know.
Mental health, anything mental health related, is that covered?
Let's get into that a little later, because there's a list of exclusions and limitations we can dive into. It's on page 18 of our outline of coverage, going through what is excluded from being paid, and we can dive into some of those.
Go for it, my friend. Not
really anything mental health related that would be covered on any of these benefits. I wouldn't see that having anything to do with outpatient surgery or a hospital confinement. If they are hospitally or confined to the hospital due to a mental illness, as long as it's inpatient, we'll pay benefits. But let's go ahead and I'll direct you guys, everyone, to the outline of coverage momentarily. So on the point of cancer, Tony mentioned that's a big benefit he likes to sell a lot of. Cancer benefits on this plan restore. So it's not just a one and done. This benefit pays again at 100% after 5 years of remission. It builds back up every year. So 10% after year 1 year free of cancer, 25%, it'll pay a 25% benefit after 2 years cancer free, 50% after 3, 75 after 4, and again, all the way back up to 100% of your lump sum amount 5 years later, 5 years cancer free. Again, you have to be in full remission, no treatment, not taking any medications for it anymore, and not seeing the doctor for anything related to that cancer anymore. Then we'll see the ability to pay again on that cancer benefit. Last 3 benefits here as far as riders go, including the ambulance benefit, which we're going to see everyone under 65. It's so affordable. We're talking $1.20, $1.80 to add a benefit like this onto your plan. It pays 3 times a year at $200 per trip in the air or ground ambulance. So not something just to shrug your shoulders at. This is something that, brings some pretty good value to the table. Usually most people just build that in before even moving on to cancer and everything else, as if it were built into the base plan. Because at that point, we're going to talk about it in a minute. At that point now, let's say we're admitted to the hospital. We take an ambulance to the emergency room and then we're hospitalized. That's probably 3 copays, 3 things that you'd have costs related to. And now we're covered for all of those for a pretty low premium. So that's 3 benefits. And that ambulance benefit is not contingent on hospital admission, just like our ER benefit, okay? So even if let's say we go to the ER in an ambulance and we're not admitted, we're still getting our $200 benefit. We just need to send in a copy of the bill, fax it into customer service claims. Okay, this little benefit here, probably not going to do too much of this. This is a benefit that pays 4 times a year at $25 per health screening. A list of the health screenings that this benefit covers are listed on the right-hand side of the presentation. Tony, if you want to grab a screenshot, annual physicals, right? Immunizations, physical exams, even a vision and hearing exam. We could get a $25 payment for something like that, even a colonoscopy, right? Blood sugar test, breast ultrasounds, chest x-ray. A lot of services covered under that $25 benefit. So pretty valuable, for some people that, that are looking at something like that. It's $100 in benefit a year for roughly, again, close to $2 a month in premium. We do have a pretty neat little dental vision hearing rider. This benefit pays either $1,000 a year or $1,500 in benefit. Okay, I know that's pretty brief, so let's go ahead and dive into it. There's a $100 deductible on our dental vision hearing rider. This is a deductible that is waived within the first 3 months for the following services. If we need a dental cleaning, we don't want someone going in, let's say 4 months into their policy, not being able to get that dental cleaning done. So even if you've had that policy for 4 months, you'll get a $75 dental cleaning benefit. That's a maximum per year. Okay. If you go in within the first 3 months, you won't get that benefit paid. You'll have to satisfy your $100 deductible. Okay. Outside of 3 months, again, we pay $50 on vision exams and $50 on hearing exams. Now, what else do we pay? What else can we use that $1,000 or $1,500 for? Well, after 6 months on the plan, we can start using that allowance for fillings, root canals, eyeglasses, right? $200 a year in eyewear, contact lenses, even hearing aids and associated supplies and repairs. So that's a 6-month waiting period on our, we could call them basic services here. Major services start paying after 12 months, such as bridges, crowns, dentures, and extractions. Okay, we need a crown done, let's say $1,000 service within the outside of our 12-month wait. Here's how we'll pay. There's a bit of a schedule, right, on how this works. So outside the within the first year, including, let's say, after our 6-month wait on basic services. We pay 60% of actual charges. Within the second year, we pay 70% of actual charges. So at this point in time, we can be using these services, this 70% benefit, for those major services that are covered after a month, after a year, after 12 months. We'll also see years 3 and beyond, we pay 80% of actual charges. That doctor's bill is $1,000. Let's say for a filling, we're going to pay 80% of a few fillings. We'll pay 80% of that $1,000 bill, so $800 after the deductible, $100 deductible. Let's check that chat box, Tony. I see them adding up.
Yeah, so
Yes,
wait a
sir.
minute, that percentage that you're showing, it's almost like a copay, right? So if they have $1,000 limit, let's just say they do that and they pay the $100 deductible, that $1,000 will only cover up to 60% of the bill. Once it hits 60%, they're responsible for the other 40, correct?
That's right.
So if that 60% is $500, they can't apply the full 1,000 to the other 40. They'll only cover either the 60% or the 1,000, whichever hits first.
So this is 60% of their bill up to the $1,000 limit. So if we have let's say a $4,000 bill, right? Crowns, fillings, a whole bunch of services. And we're in year 2 here. We have a 70% benefit up to $1,000 in benefit or up to $1,500 in benefit. Those are our 2 options. And we get a bill for $4,000. Our benefit is going to pay 70% of that $4,000. However, we're limited to a $1,000 limit on what it'll pay, or a $1,500 limit on what it'll pay. So what's 70% of 4,000? It's a lot more than $1,000, right?
Yeah.
We're going to stop paying at $1,000. That's our limit, or $1,500 if you choose the more expensive option. Does that answer your question?
Yes, I got you now.
Okay.
So whichever, got you. So the limit of the percentage is the 1,500.
Is the 1,500 or the 1,000? That's right.
Gotcha. What about, let me give you a different scenario. Let's say the bill's $500, right?
Sure.
And you're in year 1, right? 60% of 500 is only $300, but there's $1,000 amount. Can the rest of the money be used to cover the other 40, or are they still gonna have to pay the 40 out of pocket?
No, they'll get a 60% benefit of the 500, so $300 there. And then they'll have money left over later in the year to use up out of the
For other
1,000. They'll
services.
still have $700 left. Yep.
Gotcha. Can this be used in addition to a person's regular dental and vision? Can it be in addition to?
That's what I love about this plan is it's an indemnity plan. Again, no coordination of benefits. It's all cash. So yeah, you get us the bill, we'll pay. We'll pay.
How soon is the turnaround time from when you get the bill?
How soon is to pay the claim?
Yeah, so we send the client sends the bill. How soon before they get the check from you all?
Yeah, within 30 days, we should have that paid out. And then obviously give it some time to get the bill in the mail. But within the first year, when it comes to other benefits, not necessarily dental, vision, hearing, but we will, they will be subject to the contestability period.
Gotcha. Very cool.
But yeah, 30 days, give it about 30 days to be processed and mailing time.
Very cool. Awesome. 30 days. Okay.
Yeah. So almost like you could say a reimbursement, but hopefully they've got some other help on the dental cost too, and they're maybe making money.
Can this plan cover family, the dental plan, or is this just the insured?
Yeah, it's just the insured, and you would need to write a separate policy for the husband, wife, daughter.
And you don't have nothing for minors, do you?
No, this is 18 and up. 18 and up.
Gotcha. Okay, cool.
All right.
Anybody got any questions? Let me see here. Pay forever. Type them on the chat box if you have questions. There is no paid up option, right? This is a product that they basically, they got to pay every year, but the price is locked in as long as they pay it forever, right?
Yeah, the price will be locked in. It's issue age rated. And good morning. Yeah, we don't have a pay up option. No, you can pay annually. You can do your monthly, quarterly, semi-annual or annual premium options via bank draft, or you can do a quarterly, semi-annual or annual direct bill. There's no monthly direct bill. But you do have to have a bank account, a a checking or savings account to pay premiums.
What about medical bit? What about hospital stays outside of the country?
Hospital stays outside the country. We don't pay, don't believe we're going to be paying outside the country, but I can get a confirmation on that from Nick for us. So Tony, if you don't mind, write those down, a couple of the things that I'm going to work on for you. And I'll make sure I get you some answers before Monday.
Here's a big one I'll tell you right now, for example, because I travel out of the country. I'm sure everybody else does as well too, right? One of the things that you have to get when you leave the country is you got to get like a COVID insurance, right? In case you end up over there with COVID and you got to stay at the hospital for whatever reason, right? The COVID insurance covers those medical bills. So it would be kind of cool to see if this also gives cash during that period of time. So
Sure.
yeah,
I know we pay for veterans. If you have a veteran going to the VA and they can show us proof of how many days they were in the hospital at the VA, we'll pay for something like that. So I just actually kicked Nick a quick text message. We might even have an answer before the end of the call. See if we'll see. Let's see, might even have an answer now. No, we don't. We don't pay outside the country.
gotcha. So no benefits outside of the country. And then
But think
cosmetic
about that.
surgery was still a question, right? Outpatient cosmetic was still a
Cosmetic.
question.
Yeah, I'll run that down as well.
I guess cosmetic
Nice.
and cosmetic outpatient, since you have that outpatient writer, maybe the writer itself finds
I believe that's going to show us right on page 18 of our outline of coverage. I should be able to pull that up when we get to it here in a minute, but I'll shoot a quick message over to Nick while we're at it.
Guys, I gotta tell you, while he's sending this text message out, I love this product, not only personally, but I love it for my clientele because we talk so much about living benefits. But the biggest thing people need to understand about the living benefits of most life insurance companies is that there's a 90-day waiting period. So if somebody gets a heart attack, cancer, stroke, right? Like we talk, and let's just say it's the first time. So no pre-existing. Let's just say it's the first time, cancer, stroke, heart attack, and it's a severe situation, or even if it's a minor situation, right? Living benefits on life insurance means that they have to be going through recovery for more than 90 days. It's not just have a heart attack and stay 3 days at the hospital and then you're back at it and all of a sudden you can claim your living benefits on your life insurance. It doesn't work that way. You have to be dealing with medical issues for a 90-day period before the living benefits kicks in. So the way I leverage hospital indemnity is, look, if you get a heart attack, stroke, cancer, anything in that capacity, you end up in the hospital, just one overnight. As long as you added that lump sum benefit with a $600 daily benefit, just one overnight is $3,100 in cash. And you don't have to use that money to pay the medical bills. So if you have health insurance covers that, because this is outside of your health coverage. This is cash in your pocket. If it's a serious situation, right? We're talking 1 or 2 days, you get $3,100 for day one and then $600 a day for the second, third, fourth, and fifth day. And then let's just say the fifth day, the client comes back to work. They never needed to use living benefits, but they could use this, right? But if it's a serious situation, like let's say it's a real big medical situation, they're in the hospital for 30 some odd days. This is like $21,000 that they can get in cash. That $21,000 can easily cover living expenses for first month, second month, and third month while they wait for the living benefits of their life insurance to be able to get claimed, and then they can tap into that. That's where I sell that heavily. And I see Brandon's answering some of the questions there. It doesn't cover elective surgeries. There we go.
It will not. Yeah, no.
Man,
No.
I was about to say, bro, I was about to grab the Colombian market by storm.
Oh yeah, no. That's going to be in that outline of coverage. I'm almost picturing it right now. It's just been a minute since I looked at it.
Yeah.
All right. That's actually
Maria Mata asked, for people with social security numbers, do they have to provide proof of residency status?
No, they do not. We just need that social put in on the application.
So here's a good question though. People with DACA, they're kind of in a loophole because they technically have a social security number, but they don't have status.
Have a social security.
Say it again.
With DACA. Okay. No, I'm processing that.
So people with a DACA status, they're not considered residents. They're not considered non-residents. They have a social security number. but they don't have a status. They're kind of in that middle loop.
Yeah,
It's not an item.
Yeah, in the past, all I've needed is a social security number. That's all we've needed, but let me, I'll run that by Nick, but
Yeah.
I think we're gonna be just fine there.
Gotcha.
It's just part of the processing, so that's all they ask for.
I'll give you one more technical question and then let you keep going.
Sure.
Some markets love to use a bank service called Chime. And unfortunately, there's banks that don't accept Chime with their account number and routing numbers just because of the way it's set up. Can you find out if you guys accept Chime as a
Chime.
Sure. Method of payment? Because it's kind of weird. They don't they're a digital bank, but some insurance companies take it, some of them don't, even though they have an account number, routing number. If you could find out, that'd be great.
Yeah, in the past, as long as we've had an account or routing number tied to that method of payment, it's worked. But I'll put that in some notes for questions after the call.
Yeah, Rob, I know one client that we had recently, we couldn't get them through because of something similar to that. Correct, Rob?
Yes, that is correct. I'm actually looking for the bank that he had.
Okay. Yeah, we had that recently happen. We couldn't get him a policy because of the type of bank account that he had.
Okay. Yeah, I actually sent a text over to Nick, so we'll get all these answers. I might not have them all off the top of my head, but we'll run them down.
All good. Appreciate you.
Absolutely. Thanks, Rob. All right.
Yeah,
so
I think it was a Venmo account, to be honest with you. It's just
Venmo.
When you use routing an account, it's under a different bank name. But
okay,
we'll figure it out.
Yeah, I've got the question out for Chime, and then we'll run Venmo down too. So let's get into actually selling this product and illustrations, how we can break it down and show the client some value here. But really, it's going to come down to what we're pairing it with, right? For most of us on this call, it'll be our life insurance clients. All right, so it'll be mostly your life insurance clients. We'll be dealing with some under 65 as well. So in that situation, we really just need to identify their out-of-pocket exposure. I've got a beautiful slide that I've put together here for you guys to use as a starting point. And then really, when you're talking to the client, just make sure that they understand that just because they can get away with paying $300, $400 a month now for their health plan, doesn't mean they shouldn't protect themselves from some of the exposure associated with it. It's kind of like, car insurance or homeowners. We don't buy car insurance after we've been in an accident, right? Otherwise that doesn't do the job. So we need to buy insurance based on when we're going to need it the most. This is something that I've picked up from the Medicare space, but can be used in the under 65 market as well, right? So we buy insurance based on when we're going to need it the most, not based on our current health situations. So going back to what we talked about briefly earlier, that ER benefit being built in and the ambulance rider really being about $2 a month to get it added to the plan. This is a really nice way to show value to the client. So when I'm sitting with them and we've got, let's say, a $35 monthly premium, $35 is not a heck of a lot. And we go over that hospitalization scenario that we talked about earlier. Let's say we take an ambulance to the ER and we're admitted to the hospital for 3 days. Well, let's look at an example here in just a minute of how much value is loaded into a one-time benefit in that 3-day hospitalization in that scenario for just $35, $50 a month. So here's how we'll do it. Typically, I've already got this pre-built based on a program in the over 65 market, but you guys, tell me what plan you sell the most. You guys can customize this based on that plan's deductible, that plan's costs in the hospital, in the ambulance, and the ER. And we can put together a little illustration here to show your client some value. So what would a 3-day hospital stay do to your client right now in their current situation versus having the protection over here on the right-hand side to where you could end up getting a $4,300 check for that same hospital stay, right? So we looked at building a $500 a day benefit for 3 days in the hospital. Again, that's not even maxing this thing out. That's a $1,500 benefit for 3 days in the hospital. We could go up to $600 a day if we wanted to, and it wouldn't be that much more in premium. So a $1,500 check just for a 3-day hospital stay. But we've also added on a $2,500 lump sum benefit. So now we're looking at $4,000 in benefit, plus our $150 ER benefit built in and our $200 ambulance rider. So now we're looking at a $4,350 benefit paid to the policyholder just for paying that $51 premium each month. You know, if I've got a big $2,500 deductible, for example, on the left-hand side, or I've got a $3,000 deductible, you know, I'm smiling, I'm happy here that I'm spending that extra $50 a month to get some help in those situations. All right, so here we've got a quote here for Nick at 36 years old. This is the scenario we just looked at. A $500 benefit for 3 days costs roughly $15 a month. Now, when we're dealing with someone who lives with a household resident over 18 in most states, we're getting a 7% household discount there. We've added on a lump sum hospital benefit at $2,500 and a $200 ambulance benefit that pays 3 times a year. What else? Built in is our $150 emergency room benefit. That's going to be probably utilized the most out of anything on this plan, right? That benefit paying 4 times a year, not contingent on hospital admission. So we're going to go to the ER. Go ahead. Did we have a question?
No, somebody
just someone
accidentally
joining the
unmuted
call.
themselves. Somebody just
Okay.
accidentally unmuted themselves. Go for it.
Great. So let's go ahead and jump in here and break it down a little bit further to show some value here for the client. So we can take an example like we did earlier, where a client receives a $4,350 benefit for that 3-day hospital stay. Pretty good payday. Let's show them how long it would take to pay more into this plan in premium than they would receive in a one-time benefit. And by breaking it down on a monthly basis, that's 84 months or 7 years to pay more into that plan in premium than they'd receive from that one occurrence. Now, again, you know, they might be hospitalized again later that year for another 3 days. Well, our benefits restore every 60 days. So we may experience 2 3-day hospital stays in the same year. We may experience 4, right? And this benefit's going to pay every time as long as those admissions were separated by 60 days. So that could be 7 years, that could be 14 years, 21, even up to 28 years if they were hospitalized 4 times that year. Ton of value, right? That's something you guys can screenshot, you can use in the home. What I like, you know, more is I actually have an equation that I do to show the value of the cancer rider. I'm sure Tony does it in a similar manner. But really, what would your client prefer? You know, that invoice where they're subject to all those costs, the deductibles, the co-insurances, the co-pays, or would they rather be better protected and have a check payable to your client to satisfy, you know, those out-of-pocket costs? So here we've ran an illustration with the cancer rider added on. The only thing different here is adding a $10,000 cancer benefit for less than $12 a month. The reason I say less than $12 is because we got the 7% death household discount here. So we could account for that if we wanted to, but for the sake of the below illustration, I don't account for it because we're already showing them a ton of value. So when we're selling this cancer benefit, you know, whether it be with over 65 or under 65, I like to go over the odds of getting cancer in our lifetime. For me, I'm a male. My odds are 1 in 2. For women, it's a 1 in 3 odds. Then I like to really show them their costs for cancer. If they have a 20% co-insurance for chemotherapy, or if they have any type of costs, you know, on their summary of benefits or on their evidence of coverage, I like to break that down and show them. If you get diagnosed with cancer, chances are you're taking some expensive medications as well. So that's why it's important to protect yourself from that exposure. So we'll look at that same 36-year-old that we had quoted on the previous slide. A $10,000 benefit would cost us $12 a month, as we saw, minus 7%. Annually, that's only $144 a year, right? In premium. So you can see what I'm doing here. You all being in the life space know where this is headed. Now I'd like to break down that lump sum benefit, right? The face amount. I like to break down that 10,000 divided by the annual premium, $144 a year. That shows us that it's going to take over 69 years, right? Just right about 69 years to pay more into this plan in premium than your client would receive from just a one-time cancer benefit. Now, if we're selling this plan to a 36-year-old, chances are they may experience multiple, diagnoses of cancer in their lifetime since they're so young at this point. This benefit, again, we talked about it earlier, does restore 10% after year 1 year cancer-free, full remission, no more medication, no more treatment, no more doctor's visits. 25% after 2 years cancer-free, 50% after 3, 75% after 4, and 100% after 5 years. Okay. So that number could double. Might take you 130 years, 140 years to pay more into this plan and premium for 2 cancer benefits. Here's an example of just a claim being paid out to a policyholder, right? We get our itemized bill or our UB04 from the hospital. Tells us, it breaks it down by procedure, tells us what they had to pay for it. Not that it really matters how much they had to pay for it, but just proof that they did end up in the hospital or being even just the diagnosis of cancer. The doctor sends us proof of diagnosis of cancer. Well, here comes your $10,000 cancer benefit. That cancer rider does have a 5-year look back versus the 2-year look back on the base plan. But again, proof of Heartland paying out claims. So before we get into commissions, let's go back a page, answer some questions in the chat box, and then I want to show you what this can do for your business. Looks like more chat going on than questions in here.
Yeah, go ahead, because we're pressed on time. We'll save any questions for when you're completely done.
Okay, great. So 2022 commission example here, going through a first-year commission. This is just a sample. You may have to work up to a 55% commission level. You may not. This is an example at 55% commission and a 10-year renewal, 10% renewal, years 2 through 10. And then the renewal drops just a little bit, a few percent, years 11 and beyond. But this policy does pay a decent little renewal. Let's break it down. The case we saw earlier without the cancer, $51.80 a month, equates to about $621 a year in premium for that base plan with the lump sum hospital rider and ambulance. You'll see, okay, you know what? I did a 50% rate here last night when I got back from Atlanta. Must have been a little tired, but here we got a $310 comp at 50% commission. So that's even less. You'd make a little bit more at a 55 rate. At a 9-month advance, you'd be cashing in about $233, $250, depending on the percentage there. And what will that do if you're selling 2 of those a week? What will that do for you? On the annual rate, looking at the full 12 months, the advance plus the last 3 months paying on a monthly basis, we're making $621 on two sales. Okay. Now, if we're doing 2 policies a week, 52 weeks in the year, we're making roughly $32,000 a year just by adding this little policy into our portfolio. Okay. Good little example here, again, at 50% rather than 55. So Tony, I know we're a little pressed for time. You tell me, do you want me to demo that quoting tool?
I actually have it open right now on my end. I can actually
Excellent.
do that one. That's not a problem. But and guys, does anybody have any other questions? Here, I'm not familiar with your contract in hospital. Okay, so as far as fees, there's no fees to contract with this company. You want to reach out to Rob Rawl. Rob handles everything that has to do with the health insurance platform. Brandon, there you go. I can see your face. How are you, sir? I appreciate you being on, my friend. Let me show you guys real quickly how simple it is to actually do these quotes. I mean, this is literally a 10-minute process. Let let me show you guys. This is the portal right here. When you're logged in to run the quote, you literally just hit quote. So if you're gonna be doing one person, you go right here. If it's two people, you go right here. If it's husband and wife, yes, they do have to be 18 and above. You can't do this for minors, although I believe we have a hospital indemnity plan with another carrier for minors. You just got to talk to Rob about that. I don't remember exactly which company. Might be NatGen, might be United Health One. I'm not sure, but one of those has it for minors. But it's pretty simple. I mean, look, if we were going to run a quote on one person, well, let's do two people. All right, let's just say we wanted to do John and Stephanie. Right, I just kind of pick some numbers. And Rob just answered both of them. Actually, both NatGen and United Health One have hospital indemnities for people for minors. John is going to be my age, right? August 18th, 1983. And Stephanie will make her, I don't know, 1990. No, let's not do that. Let's make her a little bit older, 1975, right? So you got about a 30-year-old, 40-some-odd-year-old person. I'm gonna show you how I typically do it. I'll run it at 600, and I'll tell you why in a minute. And I'll do for 31 days. I'm gonna apply this discount right here, the household discount, because there's other people that obviously that are over 18. And I'll pick the state. Here's what's cool. If your state's not here, that means that you can't sell it. If your state's not here, you can't sell it. Simple as that, right? There's 36 out of the 50 states. California, unfortunately, is not on that. Wisconsin's not on there, but we will find you a solution for that. I think we did find one for California. But anyways, this is how you run the quote. And then you hit this, run quote. How simple it is. So right now, it's at $31.25 per person. What I typically add, I'll add the lump sum cancer. That adds there, lump sum cancer. That's another $22. And the one that I always add is the lump sum hospital confinement, $2,500. Sometimes I won't sell the cancer because the price just becomes, remember, this is a supplement, this is an ancillary product. So this is in addition to the life insurances that we're selling. And so sometimes their budget doesn't allow for them to spend $85 more per month per person. So I'll remove, the cancer, and it'll be 64 as an example. I mean, you kind of play with it, but the one way that I always show it is $600 a day for 31 days and then $2,500 as a lump sum. This $15 per day is irrelevant when you do a 31-day benefit. What this $15 per day is, so you're not confused, if you sell them on a 10-day benefit, then what happens is after the 10th day, it becomes $15 a day until 31 days. But if you sell them a 31-day benefit, right? A 31-day benefit. It's only, look at the price difference. 31 days is $64.73 a month. A 10-day benefit, $61 a month. It's almost irrelevant to show them a 10-day benefit. Just sell them the full 31 days. I mean, this is how simple it is to quote it. So notice this one here to the left doesn't have the cancer. This one here does. 1, 2, right? Husband, wife. And if they say, yes, let's go ahead and take it, click apply now, boom. There's like 7 to 8 medical questions. There's their name, their social, their bank information, where they want it drafted. What will happen immediately after that, once you hit submit, they'll get an email. They'll get an email with the application. And what I do is I make sure right then and there over the phone or on Zoom or wherever I'm at, I make sure that they open up their email and they sign it right then and there. I don't say, hey, sign it and let me know. I make sure they do it right then and there because it doesn't finalize until the client has signed it. Okay, so let me look at the chat box here, see if there's any questions, because the next thing I want to show you is how I actually present it on my dry erase board, because this is how I fit it into a lot of my sales. Let me see here. How can we get into this quoting tool? Once you're contracted, you can get this quoting tool. Once you're, which no lie, contracting takes like 2 days. It's not long. So just reach out to Rob. He'll send you the invitation to join. You'll fill out your information. They'll receive it within 2 to 3 business days. You'll be contracted, have your writing number. You'll get your welcome email and ready to go. You cannot write your own business. They won't give you advancements on your own business. It's considered controlled business, so you cannot write your own business. This is still going to operate under our normal internal consumption guidelines. So your upline essentially writes it, okay? Every VP, just so you guys know, every VP, if you have a health insurance agent in there, Have that person, if you're a VP or an SVP and you're not health licensed and you want to have somebody in your agency be like the go-to person for your non-licensed agents, right? Make sure that person gets contracted and make sure that Rob knows that is the representative for your agency. And then that person could be the one that writes up and drafts up the business, unless obviously the upline of the agent has it themselves. If that makes any sense, just let Rob know. He'll know to ask you the questions. You do have to be health licensed. You do. This is how, and I apologize. I don't want to speak fast, but I have to because we're a little bit behind schedule. But let me show you how I present it. Let me show you how I sell it. Remember, a lot of what I do, and a lot of my agents do the same thing, is we're selling permanent cash value IULs for cash accumulation, right? If you're doing a proper job, you understand that your living benefits should be separate from the IUL as well. So I'm selling an IUL for cash value. I'm selling a term life policy with living benefits from any of our living benefit companies, right? That's the second. And then the third product that I'm selling is this hospital indemnity. And here's how I solicit it. I go, look, here's today. Here's life expectancy. Right? This is called the $21,000 plan. That's how I like to sell it. It's a $21,000 plan. Why? Because if something happens to you within your first 90 days and you end up in the hospital, and it's a big thing. I mean, it's got to be a big thing if you're in the hospital overnight. Okay? This plan has the potential of paying you $21,000. On day one, it'll give you $3,100. One night over the hospital for whatever reason, as long as it's not a pre-existing condition that's happened to you within the last 6 months. Anything could be sickness related, could be illness related. If you spend one night in the hospital, you get $3,100 check. On day 2, you're going to get $600. On day 3, you're going to get another $600. On day 4, another $600. All for 31 days, you're going to get $600, $600, $600, $600, $600. Except day 1, you get what? $3,100. If you add all that up, that's $21,000. Mr. Klein, let me ask you a question. How much does it take for you to pay your monthly expenses? Well, it takes me about $5,000 a month to pay all my living expenses. So if we write you a check for $21,000, that'll cover month 1, month 2, month 3, right? I mean, if it's a serious issue, wouldn't it cover your living expenses for month 1, month 2, month 3, and leave you with a little bit of money left over for maybe the deductible on your health insurance? Wouldn't it do that? Well, yes, it would. Okay, perfect. On day 90, when you've exhausted all of this money, you can now file for your living benefit claim. You can contact American National, you can contact NLG, you can contact whichever company you're going with, and file for your living benefit claim, because now they're going to give you a larger lump sum of money that you can use for the remainder of your time period. And guess what? Your IUL hasn't been tampered with, because your IUL is designed for you to start tapping into it at 65 for cash value. So this is how all 3 policies work together. See, Mr. Client, my job is not to make sure you get to retirement. My job is to make sure you get to retirement. But if there's misfortunes that happen along the way, I got to make sure that there's insurance companies that are willing to take on that financial burden without affecting your retirement plans. And by the way, if you're not working throughout these stages, you can even use this money to pay for these premiums on your cash value tax-free retirement. Mr. Client, if you're self-employed, you definitely need this. Because let's just face it, you don't have an employer offering you disability insurance. If you spend 1 day in the hospital, that's $3,100. 2 days in the hospital, that's another $600. 3 days, another $600. So if you're in the hospital for just 5 days, $3,100 day 1, $600 day 2, $600 day 3, $600 day 4, $600 day 5. You're looking at $5,500 that you're going to get a check for. Oh, and Mr. Klein, just so you know, this also covers COVID. This also covers COVID. So if you haven't had COVID in the last 6 months and you end up in the hospital 1 day because you're having trouble breathing, $3,100 cash, Mr. Client. Let's face it, your income and your paycheck is your biggest stinking asset that you have. You can't afford not to get paid. But if you're in the hospital because of COVID and you got to quarantine yourself for 14 days from work because of COVID, guess what this can do? This replaces your income, Mr. Client. And it takes 5 minutes. Now, let me tell you this as an agent, this will pay you within a week. I mean, literally, you submit the business. If you submitted the business yesterday, Friday, you'll probably get paid by Tuesday, Wednesday of next week. Tuesday, Wednesday next week, boom, direct deposit. 9-month advance at about a 50% contract, 45% contract, do the math, right? it's a few $100 you get paid, right? And then the other policies are going through underwriting. And let's say the other policies take 3 weeks to underwrite or 2 weeks to underwrite or 4 weeks to underwrite. At the end of the day, it's almost like getting an advanced commission up front for one of the 3 things that you sold. One of the 3. I'm notorious for selling husband and wife plans like this. Husband gets a plan, wife gets a plan, they both get some IULs, they both get some term insurance, and then boom, hospital indemnity. And boom, hospital indemnity. It is solid. It is a solid, holistic plan where you can tell the client from day 1, I've got you covered, not day 91. And I'm gonna be here from here all the way to here because we did the right thing. And it wasn't one product that did it. It was multiple products that created a holistic protective plan for you, Mr. Client, all on a tax-free basis because this $21,000 is also tax-free. I repeat, this $21,000 is also tax-free. Did I say it? Tax what? Oh yeah, tax-free. Any questions on the chat box? That's how I present it, just so you guys know. That's literally how I do it. Brandon, brother, I appreciate you. Thank you so much, sir. I appreciate you being on, sir. I know that it's a Saturday. I know I got you last minute, but I appreciate you guys being on. If you need to learn more about Heartland, if you need it for yourself or you need to get contracted, I need you to reach out to Rob Raw. But you need to be specific when you tell them, so, Rob, I want to sell the product. Rob, I need the product. My opinion, every one of you, 1099, self-employed, you need this plan. This is like your disability insurance on steroids, in my opinion. That's how I look at it. I mean, it's just like that, okay? But you need to reach out to Rob Raw. The way you can best reach out to him, either you go to your ping board and you look him up, his phone number is there, send him a text message, or you go into our TKO website under the TKO Health Insurance, you'll see there's a contracting request form. Just follow those instructions. You can begin contracting and all that information gets sent to Rob and he'll get you contracted. And there's a second link there if you have a referral. If you have a referral you want to send him, put your name in there if you want to look to become a client. And for those of you that are not health licensed and you have a referral, right? If you're not health licensed and you don't want to get health licensed, but you still want to do the life side of it, it doesn't mean you shouldn't do this. Just bring Rob into the meeting, have him do this portion of that because you still want to protect your client holistically. Because here's the thing I'm going to tell you. If you don't take care of these 90 days because you're only life licensed, there's a health insurance agent that will contact your client that will try to sell this and try to replace what you did over here. There is a health insurance agent out there that'll sell a hospital indemnity to protect these 90 days if you don't. And then they'll try to replace your life insurance and your cash accumulation business because they have zero loyalty to you. At least you send this over to Rob, he'll protect this and he'll respect all of this that you did for them. He'll respect it all for you by keeping it internal. But so you're smart, you get your health license, which is nothing more than a weekend study program if you already have your life side. And that's about it. Any questions? What is the alternative for people who live in California? Maria Mata found a company that I believe provides hospital indemnity in California, but I'm not going to even lie. I've been too busy to even research it. Rob, maybe you can take point on that. Reach out to Maria Mata. I think she found something, or if you know an alternative. I know she found something, so reach out to her and see if we can get that in.
Hey, Tony, I believe it's SureBridge, their hospital-wise plan under 65.
There you go.
But that's where we have to send people in California.
Awesome. Appreciate it, Brandon. Thanks so much, bud.
Hey, no problem. Thank you.
Thank you. Thank you. Anybody have any other questions? Put it on the chat box because we're going to transition to the next topic. These quiet trainings. I love them, but I understand them. I could cut my presentation. Gotcha. All right, cool. So hopefully this was beneficial, guys. I'm just giving you kind of an insight of how it is I run my personal practice and where it is that I find a lot of my own clientele, where it is I help my clientele, because, you know, we talk about living benefits so much. It sucks. It really does suck. And I say it that way, and I apologize for my use of the language, but it does suck when one of your clients calls you up and says, man, you know, this happened. This is horrific. My husband's in the hospital because of cancer. He's got to go through treatment, or he had a heart attack and, you know, he had a stroke and this, that, and the other. And I want to file my living benefits claim. And you got to tell them, hey, you got to wait 90 days. For 90 days, you got to struggle, right? I mean, people who live in paycheck to paycheck now all of a sudden have to wait 90 days without a paycheck. Like it's a very tough reality to face. So if you can provide them, here's a gap, right? This covers the gap. This fills the gap. This hospital indemnity plan fills the gap. And here's what it can do: puts cash in your hand, can pay the deductible on your health insurance. I mean, all kinds of stuff. You really do provide benefit and value for your clients, and you're doing what's right. And let's face it, it's also income generating for yourself. Holistic planning as well too. In a payout example, the claims were made for a cumulative year. Why did they do that way instead of when they arise? I'm not sure I understand that question. So do me a favor, ask it to me in a different way. But I am going to transition to the next part of training. Go ahead. I'm sorry. Go ahead. Whoever was talking. Yes, maybe. Okay. Somebody accidentally was muted. I got you. Okay. So whoever it was that asked that question, send it to me as a private one. That way the chat box sometimes goes crazy, but you guys sometimes are talking about things that aren't relevant to what we're training on. So if you have something private you want to send to each other, send it to each other privately. There's nothing wrong with that. But I'm going to transition to the next part of it, okay? The next part, you might question why on earth is this important, right? Why is credit repair? What does credit repair have anything to do with life insurance? Okay, let me tell you guys something. I've learned a couple things in this industry over the years. People will talk to you about their credit. People will talk to you about their taxes. People will talk to you about their health insurance needs a lot faster than they will their life insurance needs. And you might question, well, why? Life insurance is so important. And you might even feel life insurance is more important than any of those three things combined. And I'm not going to lie, in my opinion, yes, it is. However, people don't like to face their mortality. They just don't. They don't like to face their mortality. Number one. And number two, you have to first build trust with them before you can have a life insurance conversation about their mortality. When someone has to face their mortality, they want to have that conversation with someone they trust. So I'm going to talk to you from a client side, and I'm also now going to talk to you from an agent side before I bring up credit repair builders here. From a client side, when I can help a client with their health insurance needs, they start to like me, they start to trust me. When I can help a client with their credit repair needs, they start to like me, they start to trust me. When I can help a client with their tax needs, they start to like me, they start to trust me. Once they like me and once they trust me, I can now bring up the life insurance conversation. I can now bring up the real conversation, right? So, all of these ancillaries that we have within our financial network, the credit repair side, the tax side, the student loan forgiveness side, I said the tax side, the credit, the health side, all of those, the commissions that they pay compared to life and annuity is, a fraction. We all know that. But your ability to cross-sell and build rapport is why these bring value. So from a client side, here's what I want you to think of. Who are the realtors that you know? Who are the mortgage brokers that you know? Who are the car salesmen that you know? Because every one of those people, every one of those professions have a list of people that don't qualify for what they sell because of credit. Realtors have a huge list of people that want to buy houses, but they can't because of credit. Look at who's on right. Zavala, Lizette, you're a realtor. Don't you have a list of people that want to buy houses and they can't because of credit? There it is, right? Like for my car salesman, you have a bunch of people that want to buy a car and they can't because of credit. For my mortgage people, you have a bunch of people that want to get a mortgage to buy a house, but they can't because of credit. So what if you call those people up? You make them a center of influence. You make them someone that refers business over to you, okay? And because they refer business over to you, you help them with their credit. You get to build rapport with those individuals. And when you built enough rapport and they like you and they trust you, guess what you now get to do? You get to ask for permission for the life side of the business. And guess what? When that credit does get fixed, you can send them back to Lizette Zavala, right? If Lizette's your COI. Hey, Lizette, this client that couldn't get that mortgage, here it is. Their credit is fixed. Help get that mortgage. You know what Lizette's going to do? She's going to send you so much business for people that buy houses. Hey, this guy bought a house. They need mortgage insurance. Hey, this guy sold a house. They just made $200,000 in their sale. Talk to them about annuities and stuff because you're creating a center of influence. That's from a client side. From an agent side. And don't unmute yourselves to answer the question. I just want you to answer the question for yourself when I ask you this. Do you have it in your goals to one day run your own agency? Let me take it another level. Do you have it in your goals to one day run your own FMO? Do you have it in your goals one day to be able to talk to carriers and negotiate contracts and be like, listen, my organization can give you X if you give us this. How much production do you want? But this is the comp levels that I want. Do you have it in your goals to one day build your own payroll department, your own marketing department, your own carrier departments? Do you have it in your goals one day to maybe run a captive operation, a non-captive operation? Do you have it in your goals to one day run a whatever? Do you have your goal? Do you have it in your goals one day to run an entrepreneurial business? If the answer is yes, you need to build business credit. This isn't just about flexing and using your life insurance license, guys. Yes, you're building a reputation in the insurance industry, but if you one day want to be able to build a business, you're going to need business credit. And to start building your business credit, you need your personal credit to be in line. To be able to get contracted with some of these bigger companies that we have, you need to have decent credit if you want to get advancements of commission. Because what's an advancement of life insurance premiums? It's a loan. It's life insurance companies saying, hey, we're going to give you the money ahead of time as a loan, non-collateralized, in hopes that this client makes their monthly payments. Otherwise, we got to charge you back. And so you need to have decent credit in order to get companies to approve you for that. That's the independent world. So listen, Credit Repair Builders is a company that for the last year and a half we've partnered with. The face of that company is ran by Natalia Lopez. If you've sat in on her trainings, you know that she knows her stuff. She knows her stuff better than most people. She advertises like crazy on social media, so make sure you follow her on IG. Somebody do me a favor and every now and again get in her ear and tell her to start working the Facebook market because I think she'll triple her income if she does that. But I want to bring up Credit Repair Builders. I want you guys to take a lot of notes, even if you don't see yourself as a credit repair agent. I don't see that for you, but understand what it does and what it can do for you if you want to build your own FMO one day, but what it can do for your clientele as a way of building COIs with realtors, mortgage brokers, and car salesmen. Without further ado, I give you none other than Natalia Lopez in the house. Can you hear me, Natalia?
Yes. Hi, guys. Welcome to another Closers College, I think February edition, right? So I'm basically going to go over how the conversation for Credit Repair Builders goes whenever you're explaining all of our services to your potential client. Finding a potential client for credit repair can be so easy, and you can literally find it in anyone, as far as like talking to your close members of your family and your friends. Before you know it, you're going to have people that are interested, because as we all know, we all need good credit. We all need credit to basically move on to that next chapter in life. If you're looking to buy a home, buy a car, even, move into a leased apartment, they also check your credit. So we all know that like our credit score is literally our adult report card. It puts us on a spectrum of how responsible you are, how many on-time payments you have. It literally is a number that shows people how reliable you are and how good of on-time payments you can make. So whenever you mention to anyone that you're working in a TKO financial network that has a lot of different branches, one of the branches is credit repair, people are going to automatically want a lot of free credit advice from you. They're going to ask you a series of questions that are important for you guys to know how to answer. One of them being, how long does a program take? So the program can take anywhere from 3 to 9 months. We don't usually keep our clients for longer than a year and a half. Our program is designed to kind of get people to where they need to be so that they can move on to the next phase or the next chapter in life. So Credit Repair Builders offers 3 main services: credit repair, credit enhancement, and then we can also negotiate a settlement for their debt. So something that's super, super important to explain about credit repair is that it is a legal process. Some people think that it's like, a scam. A lot of people have been scammed by previous other companies that have had to do their credit repair before. So it's a very sensitive topic. And that's why I like all my agents to know what they're talking about and know the topic fully, so that the client can feel that confidence in them and trust them with, like, because this is all like sensitive conversations. Like, we need their social, we need basically like their credit history. So credit repair is a legal process. We send out attorney formulated letters to the creditors and to the credit bureaus to be able to dispute the negative things off their credit history. So super important. We're deleting the history of the debt, but we're not deleting the debt itself. The debts have to continue to be paid. Things have, everyone has to continue paying their debts as usual. But we are deleting the history of it. So put it in perspective this way. If you're looking to buy a home or a car within the next year or so, it would be in your best interest to have the cleanest credit history available to you so that you can then qualify for all the best, like the best loans, the lowest APR, you can get the best deals when you have cleaner credit history. As we go along deleting the negative things that you have weighing down your credit score, your score will start to rise. Naturally, once you start deleting negative things, like derogatory items that are left on your credit history, your score will start to rise naturally. So if you guys are taking notes, this part is super important. People are gonna wanna hear, what does your program do? What do you guys truly offer? So our software is designed to remove a number of things. I'm going to give you pretty much a short list of things that we're able to delete with our software. We're able to delete inquiries. Anytime that your credit score is pulled or your credit history is pulled, that lowers your score as well. And hard inquiries, we're able to remove. We're able to remove late payments, 30, 60, 90. Anytime you've paid any credit line late, that goes on your credit history as well, and it lowers your score. We're also able to delete, collections. When you have a debt and you don't pay the person that you owe the debt to, like let's say Macy's, you don't pay Macy's, then Macy's sells that debt to a collections agency. Collections also go on your credit history and they weigh down your score by a lot. We're also able to remove charge-offs. Once you don't pay a collection, it then gets sold to a charge-off agency, which their only sole purpose is to collect that payment from you. So they'll say, you can work on like a charge-off basis. Like they'll say, okay, so you don't have the 500, but if you pay me 400 now, we'll close out the debt for you. That's a charge-off agency. We're able to delete that from your credit history. We can delete repossessions. We can delete foreclosures. We can delete bankruptcies, judgments, tax liens. The only two things we're not allowed to touch is child support and student loans because they're government regulated. Everything else, we're able to delete from your credit history. So anyone that could be interested in potentially having their credit restored or repaired is pretty much, people already kind of know what's wrong with their credit. They also know where they want to take their credit and where they want to go next, as far as like they have a certain goal in mind, and that's the kind of like that's kind of like the light at the end of the tunnel. That's kind of what we're all going to work towards to help them acquire at the end. So if you guys see here with the screen share, we have our flip chart. This is the flow of the conversation, the way that it would go whenever you're explaining Credit Repair Builders and our program to anyone. Remember, I told you guys the program, our client can be in the program from anywhere to 3 to 6 months or 3 to 9 months, depending on how severely hurt their score is. No two people's credit is exactly the same. So you can't give them an exact number because it is a legal process. So what I mean by a legal process is that credit works by rounds. Every month is a round. So at the beginning of that of your month, I send out the letters to the creditors and to the credit bureaus. Okay, I don't send out 3 letters per client. I send out as many letters as I possibly can per month per client. So let's say I send out those 30 letters, right, to the creditors and to the credit bureaus. They now have 31 days to respond to my request. The client will receive letters to their home of all the response that they get. Whatever they do not respond on by law, they have to be removed from their credit history. That's the Fair Credit Monitoring Act of 30 days. It's basically just a law. It's a little backdoor loophole that we were able to find that gives the creditors 30 days to respond. If they do not respond, by law, that derogatory item has to be deleted from your credit history, which, as you know, as things get deleted from your credit history, it'll make your score start to rise. So looking at the flip chart, it basically explains the flow of the conversation, so I'm gonna run through it quickly. So the first thing that all of our clients have to do is sign up for Identity IQ. Identity IQ is a credit monitoring website that allows us to see their credit in a more organized way. It helps me categorize all of their derogatories. So I'll have literally a category for late payments, inquiries, collections, charge-offs. And that way I can go ahead and design a specific plan to attack their credit. I don't attack everyone's credit the same. Not everyone's goals are the same. Some people are like, hey, I want to buy a house within a year. What can you do for me in a year? So then I go ahead and I attack all the harder things first. Like I said, we're able to delete a wide number of things. If you guys want this flip chart, I can email it to you. And as you saw also on the screen share, it's in our TKO Financial Network website under the credit repair tab, which is kind of at the bottom of the scroll down menu. So like I was explaining before, once I go ahead and put the client in the software, it shows me their credit in a more organized way. I design a plan specifically made for them. Then the 30 days start. Remember, it's a very timely process. Every month is, on a schedule. It's timely. It has to, all the letters have to be out by a certain date so that they can have enough time to respond. And that way we can make progress within that month. Every month I touch base with each and every client. I let them know, this is how many points your score went up. This is how many items we were able to remove from your credit history. And I also like to be very transparent. And if I see that they're also, doing things with their credit that are affecting them negatively, I also let them know, hey, this is how many new accounts you have. This many are derogatory. All of our clients also have their own online portal that they can log in to see all of our progress. They can go in and see everything that I've done that month, every letter I sent out, and they can see everything they have on their credit history, whether it be in good standing or in bad standing. So within the credit repair phase, I'm able to remove about 50 to 80% of the history of the debt that they have on their credit history. Now, realistically, not everything gets removed every single time for every person. Some things do linger and some companies don't budge, but whatever is left on their credit history, we can then enter a process of negotiation for them. So we can negotiate a settlement. Let's say you owe $5,000. I try to negotiate for them to only pay, $2,500 or less of their debt, so that, obviously nobody wants to pay the full amount of the debt if they can pay less of it. So we can negotiate a settlement for whatever is left. After our client has reached a certain score or has gotten to the point where they qualify for phase 2, I then give them the opportunity to choose if they want to continue on to the credit enhancement phase. Credit enhancement is something that one of our services that we also offer. It's called trade lines. So Credit Repair Builders has partnered with their own private investors that their only purpose is to rent out their positive credit history to you. They rent out their positive credit history. You attach yourself to their credit history. You're not using their own credit cards. You're only attached to their credit history for about 2 months, 60 days. And within this time frame, your score is going to be boosted. Your score is going to be, an average level of between your score and their score together. Because remember, your credit, whenever they pull your credit, they're going to be able to see their positive credit history as well. So this helps you. This will help your score increase dramatically. So this part is called funding. So once we help you acquire the trade line, within those 60 days, it would be in your best interest to use that to your advantage, and make the most of it, and then apply to get your own lines of credit under your own name. So think of it, if your score is at 790, it would be in your best interest to apply for that house, to apply for that loan, to start your business credit. Remember, you need good personal credit to have business credit. So the trade line has to be done strategically, and everything has to be kind of done in a timely manner so that you guys can acquire whatever it is, the goal that you were looking to reach at the beginning of the program. Whatever it is that you were looking to get, we help you get there. I know some people are writing in the chat, and I'm gonna answer Q&As in a little bit once I'm done. Once you have acquired your own lines of credit while you're using the trade line, remember the trade line doesn't last forever. It lasts 60 days, 2 months. So in those 2 months, we have to take advantage as most as possible to help you get your own lines of credit. Once you have acquired your own lines of credit, or you have gotten you reached the goal that you were looking to get, we then take you full circle by removing all the inquiries that you acquired while you were applying for your own lines of credit. Okay, and then hopefully by step 10, you reached your goal and Credit Repair Builders, saved the day. These items that we are able to delete from your credit history could come back. In my experience of over a year and a half of doing, of running Credit Repair Builders, I've never had any client, current client, or previous client come back and tell me that any of their items came back to their credit history. So far we're doing super good. If anyone has any questions, I'll be more than happy to answer, or any comments you can write in the chat. You can unmute yourself, you can raise your hand. So let's see, I have a few questions here. Okay, you're already certified in credit repair. Okay, can they use the service with that one to repair their, okay, so the question was, I have clients that use debt mediator solutions to resolve their debt. Can they use the service with the one to repair their credit?
I
So
can answer that one. That's fine. Is it Mediator Solutions? Are you still using Mediator Solutions from the past organization? I don't know if you will continue to be able to. I'll be honest with you. But yes, a debt consolidation company. Let me tell you my personal opinion on debt consolidation companies. It's good for the person that wants to qualify for a home in the next year or two, because well, no, let me think about it. It's good for the person that doesn't plan on making a major purchase. It's in reverse, I apologize. It's good for the person that doesn't plan on making a major purchase in the next 7 years, because a debt consolidation is basically you reaching out to the companies and saying, hey, I wanna settle this. And unfortunately, when they accept your settlement, they have to report on your credit that you accepted a settlement, which hurts your ability to purchase things in the future, hurts your ability to purchase, make big transactions like a car, like a house and stuff like that. So if the person does some type of debt settlement, they have to be in a position where they're like, okay, I'm not going to be in a position, I don't need to be in a position to buy anything big, AKA a home, in the next 5 to 7 years, because I know my credit's going to be somewhat tainted there. It's going to report that I settled a debt, and no lender wants to see that you settled a debt. So can you? You can. I personally believe that doing the credit reparation is going to be the best route for them first. Let's see how much stuff we can eliminate, period, from the debt before you settle. I'll tell you where this helps out a lot. People who want to buy a home, you do credit repair, you fix their credit up, their scores go up, they get their home. And then here's the thing about the credit repair. There's no guarantee that some of these things aren't going to come back. They could come back later on. But if it's for the purpose of building your credit now, buying a home now, doing stuff now, qualifying for credit now, then take advantage of the credit repair. And if the things pop up later in the future, you would have already accomplished the goals that you wanted to accomplish, and then you can go ahead and take care of them in the future. As far as the question that you're already affiliated with credit repair and what do you call it? And you are an Identity IQ affiliate. You can, I mean, technically speaking, if you already have that, why don't you just implement that into your practice? For example, we have a massive tax preparers organization that's partnered with us, right? We have, but outside of that, within TKO, there's a tax preparers division. What is that? That entire agency does? They leverage their own personal tax preparation services, but then they leverage TKO for credit. They leverage TKO for insurance. They leverage TKO for annuity. So if you already have a credit business, I would teach you and your agents to use your service for the credit repair and not necessarily leverage Credit Repair Builders unless you feel that you need the additional support. Hopefully that answers the questions. Are there any other questions? And if not, I'll let Natalia keep going.
Well, at this point, Tony, I would basically play the video that I always play. I don't know if you want me to play it. It's just you talking, or I don't know if you want to just.
No, I'll do it. I got it. I got you. No problem. I know you got to run. Natalia's got to run. She's got some things she's got to take care of. So, that's not a problem. I'll keep going here. Let me see here. The credit repair does not get rid of the debt. So here, let me explain what I mean by this. Where am I? Gallery, no, speaker, blah, 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 blah. Let me turn mine on. There we go. Okay. The way the law works, right? The Fair Credit Monitoring Act is a law that basically says if a lender receives a notice from the person saying, hey, this isn't right, they have 30 days or so to respond. What people need to understand about the way debt works is that it's a business. It's literally a business. So let's just say hypothetically, right? You owe Rooms To Go money, right? You got a credit card with them. You didn't make your payments for whatever reason. You owe them money. What happens, Rooms To Go hires a collection company, and they tell the collection company, look, I need you to try to collect this debt, call them, do whatever you need to do. Here's all the paperwork to show that this debt is valid. The collection company says, okay, I'll do it, but I want 10% of whatever we collect. So they're going to try to collect as much as they can because they want to increase that 10%. What happens is when the collection company goes 60 days, 90 days, 120 days, 180 days, and they can't collect the debt, they sell that debt to another collection company. Typically collection companies only like working new debt because they know the longer the debt becomes, the harder it is to collect the money. So when debt starts to become really long, the collection company will actually sell that debt to another collection company and another collection company, another collection company. And they'll tell them, here, if you collect anything, you get 10% from Rooms To Go. And then they sell it to another one. Hey, if you collect anything, you get 10% from Rooms To Go. I'm just using that as an example. What happens is with the transfer of debt from one debt company to another debt company to another debt company, paperwork gets lost. So the initial paperwork that validates the debt doesn't sometimes transfer over to the new collection company. So now the debt's 2-3 years old in collections. It's with the third or fourth company. You send them the letter. That letter's like, hey, credit repair sends the letter saying, hey, I challenge this debt. It doesn't exist. The collection company's like, holy crap, we don't have any of the paperwork to validate this debt. So then they have no choice but to get rid of it. Right? Now, sometimes, not all the time, but sometimes those collection companies will go right back to the source. They'll go right back to Rooms To Go. I'm just, again, using Rooms To Go as an example. They'll go right back to Rooms To Go and be like, hey, Rooms To Go, listen, they requested validation of this debt, and Rooms To Go be like, oh, here's the paperwork. So if the paperwork does appear back up later, the debt could come back. But here's the reality right now. Look at the national deficit, where it is. I think we just hit, 30 trillion, some crazy number like that. Look at what happened in the last 2 years because of COVID and people losing their jobs. People's debts is crazy right now. And so collection companies have more work than they can handle. So when they see somebody actually fighting back, leveraging a credit repair company like Credit Repair Builders, sending legal documents consistently and aggressively, a lot of the times they just tend to just kind of wash their hands. They're like, you know what, let's just move on to something else because these guys are fighting back and they're making us do more work than we want to do. So what we've seen over the last year and a half working with this company is that sometimes the debt comes back, but a lot of times it doesn't. It just kind of goes away. And so again, there isn't a huge commission in this. It's like $50 to $100. You send over a credit repair client, you're going to get $50 to $100. But here's what you want to do with Natalia. Natalia sends that client a report once a month of how their credit score is increasing. What you want to do is you want to be a part of that, right? So if you refer something over to Natalia, make sure Natalia gives you updates on the increases. Make sure Natalia gives you updates on the improvements. And when those improvements happen, it gives you an opportunity to attach yourself to that improvement. And here's how you get to attach yourself, right? Natalia hits you up 30 days after and says, hey, this guy's credit score went up by 20 points. Here's a screenshot. What are you going to do, right? Communicate with the client. Hey, bro, congratulations. Listen, your score went up by 20 points, right? You went from a 6 to a 600 to a 620 or a 580 to a 600 or whatever. Congrats, man, that's awesome. That's great. That's this, that's that, right? You're now in a positive conversation with them. They're now valuing who you are. Maybe the next month it goes up another 10 points. Next month it goes up another 15 points. I mean, you deliver good news enough times, guess what you now get to do? Hey, listen, we never really had a chance to chat about some of the additional services that we offer. You're over in Fort Myers, right? Yes, I am. I'm gonna be by there next week. You think we can grab some lunch? You know what your client will say? Heck yeah, come by, bro. I'll buy you the sandwich because you've been helping me so much with my credit. So now you have lunch with the client. You get to do what? Introduce your other services, life insurances. Hey, do you have any old 401ks? Hey, do you have life insurance in place? You realize how cost effective it is. Do you know that when you get your house, you're going to probably need to have insurance to pay off that mortgage in the event of? Would it make sense to have a conversation now about that? But you get an opportunity to build more rapport with that client, and eventually through that process of building more rapport, you get to sell insurances, annuities, health insurances, hospital indemnity, like we just trained on. You could even see if the person maybe needs their taxes to get done, refer it over. Maybe they're interested in e-commerce. At the end of the day, you sold the most important thing first, yourself. The moment you finish selling yourself, you get to now ask for permission for all your other benefits. And maybe they don't have a need for it, but maybe they'll refer you now. At the end of the day, it's somebody in the community that benefited from their relationship with you that one day will need your services, whether it's now, later, or as a referral. Does anybody have any questions about that relationship and how you can leverage it to your advantage? Can I purchase business and trade lines to credit builders if I'm not a credit repair client? If I only need the trade lines. So the question, can I go to trade lines? You can go right to trade lines, but you need to do at least 1 month of the credit repair. So the trade line companies, the trade line partners that we're partnered with require us to do a full analysis of the person's credit, make sure that they're in a position where they can do the trade line investing. So you need to do at least 1 month of the credit repair, which I think is $175 for the enrollment. It's super cheap. I don't know if we talked about the pricing, but it's $175 a month on a month-to-month contract. Identity IQ, I think, is $25 a month. So it's like $200 a month. It's super cheap, right? But you got to do at least 1 month of the credit of the credit repair before you can go into the trade line, because we can't. They cannot bring a client to trade line investing who isn't in the right place to do trade line investing, and the only way to see if they're in the right place is by doing an analysis of their credit, which is that first month of credit reparation. Maybe they do nothing in that credit reparation, but they do need to. How much of the trade lines? That depends. What happens is when someone's ready for trade lines, credit repair reaches out to the firms and says, hey, I got a client who's looking for a $10,000 credit card, a $15,000 credit card. What do you guys got? And then they're going to sell it at market value, right? I got a card that's 5 years old, that's got $10,000. It's an American Express card, or whatever. It's from Capital One. It's got a $10,000 balance. I mean, it's got a $10,000 available line and only $300 balance. I'll sell it for $600, $800. The market rate changes, right? From what we've seen, it could be anywhere from $400 to $800 for every 10,000 or so. And then what they'll do is they'll add you as an additional insured for 30 days. They'll give you a guarantee that 2 out of the 3 credit bureaus will report that credit card. And in that 60-day period, your credit score jacks up. When it jacks up, you apply for your own personal credit, because you'll know that you'll get approved, so that when they remove their trade line, you've got your new credit card. I work with a few who do 10%, 2,000 for 20K. Cool. I mean, yeah, we that might be something to chat with Natalia about. But let me give you some numbers here. Last year, we looked at the books. 75% of our credit repair clients became life insurance clients or health insurance clients. 75% of them did. So what's my advice, right? My advice is simple. Put together a list, build a center of influence market. You want to know how I built 200K a year as a personal producer without recruiting? I had people that would send me referrals. I became a mayor of my community. So here's what I recommend you do. Put a list together of all the realtors you know. Put a list together of all the mortgage brokers you know. Put a list together of all the car salesmen you know. Put a list together of all the people that you know that run like home remodels, bathroom remodel, kitchen remodels, all those types. Put a list together of all those people. All of those people need their clients to have credit or need their clients to have lump sum cash to buy the products that they want. 99% of them are buying these products through credit. Cars through credit, homes through credit, mortgage credit, right? A reconstruction of a kitchen, a reconstruction of a pool, a reconstruction of a bathroom, credit. Which means all of those people have a list of people who don't qualify for the products that they sell because of credit. So put that list together. Call them up. Call them up. Hey, how are you? This is Gerzo. Listen, I wanted to talk to you a little bit about some of the services that I'm bringing to the table within my own financial network. Oh yeah, what company do you work for? Well, I got my own company. It's called Gerzo Financial Services. Now you don't have to say TKO. This is you building your brand. This is Gerzo Financial Services. But one of the things that we're doing is credit reparation. And I thought you probably had a list of people who haven't been able to buy a house or haven't been able to buy a car, whatever they sell, because of credit. I wanted to see if you can allow me an opportunity to help those individuals, because when I fix their credit, I'm going to send them right back to you so they can buy that product that they wanted to get from you. And here's what I'll do. I'll give you kind of a quarterly update on where they are. And if any of my clients, and if anybody you refer me comes on board, listen, I'll give you a gift card for $25 to Starbucks, or a gift card to Panera Bread, or whatever. But now you know what you have? You have people that are sending you names and numbers, names and numbers, names and numbers. Start with credit, build rapport, divert right into a life insurance conversation, a retirement conversation, an e-commerce conversation, a health insurance conversation. Who knows? At a minimum, you make $50 to $100 on the credit repair referral. You sell a hospital indemnity, make $200-300. It was still worth the time. You do that 4 or 5 times a day, you're making $1,500 to $2,000 a week. Just on that, but you're building your network of people. You're building your network of people. And if you have annual reviews with those people on their birthdays, because you created one of these bad boys, and I can explain this later on what this is, you're having birthday reviews with people. Now you find out, oh, how's life changed? Oh, I got married. Well, we need to talk about life insurance. Oh, I got a baby. We need to talk about life insurance. I got divorced. We need to talk about life insurance. I bought a house. We need to talk about life insurance. You're building rapport. You're building your center of influences, you're building your network, and little by little, you'll start to see it feed you and feed you and feed you and feed you. There's nothing better. There's no lead list better than that. Any questions before we move to the next subject? What do we have next? Let me see here. It's 12:15. All right, good. So we're almost caught back up. Let me bring up our next. Let me ask a question on the chat box. Has this been valuable? It's tough for me when I don't get to hear you guys, but I understand. If this has been valuable, let me just get a couple quick yeses, or heck yeses, or no, Tony, you suck. I'm okay with that too. It's all right. I won't get offended. I promise I won't. Okay, let's bring up the next one. Thank you so much, guys. I appreciate you. I want to bring up Rob Raw. Robert Raw runs an organization. Rob, what's your agency, brother?
Team Vibe, Vision
Team
and
Vibe.
Building
That's
Excellence.
right. Vibe Insurance, if I'm not mistaken, right? Team Vibe. I like that. So Rob runs an organization with his wife, Angela Raw. They live in the South. They live in the South Florida market. Rob's got over a decade experience in the health insurance space. Angela is the killer, the beast when it comes to selling in the life insurance space. They're a power couple. They run a massive agency. TKO has partnered with him because of his experience in the health insurance world. He runs a training every Tuesday on the health insurance space. Let me tell you how awesome this is, what he's about to do. He's going to show you how to cross-sell health insurance into the life insurance world. He's going to show you how profitable the health insurance short-term medical world is. You've already heard from the hospital indemnity side of it. Did you say Team Vibe? Yes, he's from Team Vibe. That's his organization, Vibe Financial Services, Vibe Insurance, something of that nature. But he's working on getting us his logo so we can finally get him into the website. But let me get back to it because my ADD kicks in. The whole purpose of this, again, all of these networks is to get you to cross-sell into the life and to the annuity side. That's what it's for. That's 100% what it's for. So what better way to do it than to leverage the health insurance space? So many people want to talk about health insurance right now, especially because they either lost their jobs because of the pandemic and they used to get their employer benefits that they don't have anymore, one, or media scaring the heck out of people with COVID or putting people to say, hey, I need to get some health insurance in place because I need to make sure I'm covered just in case. At the end of the day, people want health insurance. And there's this amazing program called the Affordable Care Act that lets the government say, hey, we're going to pay for your health insurance. And if you qualify under certain provisions, it'll be free to you. And if you free up that money for health, what can you do with that money that they originally had set aside for health insurance? Divert into what? Supplemental insurances like hospital indemnity or life insurance. So without further ado, I bring you Mr. Rob Raw, give him your attention, give him your love. Let me hear it on the chat box how excited you are to hear from Mr. Rob. Rob, the floor is yours, my friend. And you are the
Awesome. I appreciate that, Tony. Appreciate that intro. What's up, guys? What's up? I was just looking at a lot of the participants here, and I think this is a Team Hope takeover is what I'm looking at. If there's anybody else representing there, is there any other teams out there, or is it just Team Hope? Hope, see, hope. See that, guys? Come on, let's go. I love that. So right now, yes, cross-selling is definitely available within health insurance, within credit repair, within taxes, within this network that we've developed within TKO, which I'm very thankful for. Not to mention the automation with Jarvis. If you guys don't know about Jarvis yet, you got to jump on that. Makes you pretty much available 24 hours a day. Put some fire underneath your butt to be like, oh snap, there's people messaging me left and right. I got to answer. I got to be available, right? So this makes you become a full-timer, okay? Now, with the health insurance side of things, I'd love to be able to give you guys a few questions that I normally ask my clients so that you guys can feel a little bit more comfortable about how to speak about health insurance and what are good prospects and not so good prospects. So at the beginning, you got health insurance overall. There's so many different options in health insurance. The main two that we're going to talk about today is ACA, which is the Affordable Care Act, Trump Care, Biden Care, whatever you want to call it, right? It's the Affordable Care Act. And then you have non-ACA, which is short-term medical indemnity, some of the other things that we talk about. But as far as those two different options, those are the ones that we're going to be talking about. There's others like TRICARE for our veterans. There is coverage through an employer. A lot of times you'll be speaking to people that have insurance through work, but they might not like it or they're paying too much for it. Let's talk, because there's a certain percentage of income as opposed to your monthly premium that that they're taking out of your paychecks that we could probably get you at a much lower rate. So kind of just going back to the main two different options and how I decipher, which way I'm going to go, either ACA or non-ACA. The first thing after building rapport with the client is, just tell me a little bit about your situation. Do you have health insurance now? It's a great opener. If they don't, when was the last time you did have health insurance? Kind of go into that conversation with them. And then let's see, what made you start looking? If it's been some time since they had some health insurance, what made you start looking? Did something happen? Try to do some more fact finding when you're asking these preliminary questions, because that's definitely going to help you on the back end with assuming. All right. Any questions so far? No. All right, cool. I will be looking at the chat. So if you have any questions, I will have that open. Got a few screens in front of me, so I'm just going to try to keep up with everything. I am going to run this a little bit quick. I talk fast, I walk fast. So let's just run through it here. So, and I know some people are probably hungry. If you guys didn't eat breakfast, I got you. I'm gonna wrap this up real quick. Okay, so the next thing is how many people are we looking for coverage, right? Household size is usually based upon taxable household size, unless you go non-ACA. If you go non-ACA, it doesn't even matter. You could have a nephew, a niece that you want to have, make sure that they're insured. You can actually, cover them. Now, you can also cover a child at 2 years of age or older. For infants, you have to be on a policy with somebody that's 18 or older. Yes, I love the health license. That's what's up. All right, that's not easy. That's not easy to do. I know Tanisha got her license. I know someone else got her license recently. So I love hearing people getting licensed, because that means appointments are coming up. Number one appointment that everybody should be getting if you're health license is Heartland. Heartland is number one by far. You guys saw that training just earlier, so definitely want to jump on that. If you have not been, if you didn't start the paperwork yet and I sent it over to you, it is time sensitive. So please, if you ask for it, do it within that day or within 24 hours. So Now, within the household size, usually you want to figure out about their health. So are they taking any medications for anything? And this is also going to kind of touch back onto the life insurance. I mean, you need to know who's taking what medications for life insurance. So you got to be a little bit of a field underwriter at the same time, right? So figuring out if they have any upcoming surgeries, if they have any treatments. You might come across some people that have Cobra, kind of going back to the insurance, like, do you have insurance now? If you hear of anybody that has Cobra, oh my God, they're healthy. We could save them so much money, so much money. So going back to the pre-existing, if they have any pre-existings, we definitely want to go with the ACA because that covers pre-existings. Anybody that's pregnant, we want to go with the ACA because that covers pregnancies. So anytime that we have somebody that's making too much money, Cobra is sky high. That is correct. So Cobra can range anywhere from $500 to $700 per person. And if you're a healthy individual that doesn't need all that extra stuff, if you're not in the middle of getting a surgery or about to get some follow-up surgery or whatever the case may be, I really don't think it's worth it. Unless you're in the middle of a pregnancy, or you just really like the plan so much you're okay with paying that money, then go ahead. But we can definitely save a lot of people hundreds of dollars monthly, which turns out to thousands yearly. Now, so medications, we got the taxable. Okay, and so for people that are making too much money, okay, let's say that we have one individual that's making over $120,000 a year. That individual, if they decide to go with the ACA, is going to spend anywhere from $400 to $1,000 a month. But that's going to cover pregnancy, pre-existing, and those types of things. If you don't need that, then why pay extra for it? So that's why we would go with the non-ACA in that type of situation where they don't need the pregnancy, they don't need the pre-existing. We always suggest high deductibles, as Brandon was saying earlier. Why? Because what's the point of getting a lower deductible when you still have to pay that first? It's going to cost you more money and you still have to pay that deductible. So what we normally do, and I suggest to just about everybody, is that we go with a higher deductible, spend less monthly, and then fill that deductible with that Heartland, or if you're a family that needs some coverage for children under 18, then National General is a really good company that has some indemnity there for sickness or just hospitals, accidents, and even cancer, heart attack, stroke coverage. And it's really cost effective as well. Not as high as commission, but we got to make sure we do right by our clients no matter what, right? So as long as we're providing value, that's the most important part. And then when I get closer to the end, when I try to figure out, who's ACA, who's non-ACA, who's income, who's got pre-X, who's got all these different things, at that point, I ask, is dental and vision something that's important to you? And 9 times out of 10, people will say yes. And we'll also ask for a budget. If you have an ideal price range or budget you're trying to stay within. So the company names that we work with is going to be United Health One, National General, and Heartland for most private market options. That's non-ACA. That's our main 3 that we're going to be using. Then you have ACA, which is United Healthcare, Oscar, Blue Cross. I mean, we work with just about everybody on that spectrum for the Affordable Care Act. Now, it looks like we're going to be introducing California really soon. I'm really glad that we got that out in the open. Hearing from Brandon, he said Surebridge, which is one we're going to start looking at, and then Washington National is another one that I heard from. Maria, thank you for sharing that with me. So we're going to be getting that. I'm hoping within the next week or 2. So that way we'll have contracts set up for that as well. But that's ultimately it, guys. Once they give me that budget, once they give me that, is dental and vision important, I come back with the elite package. Who doesn't want something that's elite, right? So I have the elite package, which comes with dental, vision, health, and hospitalization coverage, or life insurance. So I'll do either one or the other or both, depending on what their budget is. So an individual making decent income, right, we'll say around $200 a month. You could definitely fit a life insurance policy, a hospital indemnity, as well as health and dental and vision, all within $200, all of it. So that's generally how we can help individuals. and just help anybody and everybody. Honestly, there's nobody that we can really turn away unless we're helping them apply for Medicaid or something through the state. But other than that, guys, I wanted to go ahead and again, okay, I did pretty good on time. Does anybody have any questions on anything at all that I've gone over, or contracting, anything like that?
Any questions? Any questions? Anything having to do with contracting, guys? Again, you go to the TKO website, you'll see TKO Health Insurance. There's 2 buttons there, one for referrals that you could send directly to Rob, or one to begin contracting. Just click and follow those steps. From a Cliff Notes standpoint, this is how I leverage it a lot, right? I always start the client off with, after building rapport, is what's your budget? Right? What's your budget for health insurance? Everybody has a budget in mind. They all do. They're going to say, oh, 150 or 500. Like most family plans is 500 to 1,000. I just got referred to a guy who's getting quoted $1,500 for his health insurance. And he's like, look, I can't afford 1,500 for my family, but I can afford 1,000. Right now, they make really good money. So, but again, what's your budget? Most people are going to tell you 150 to $200. This I have happened a lot. 150 to $200. Okay, great. Let me see what I could do for you. Let me see what I could get for you at that 150 to 200. Mr. Klein, if I could find you health insurance along with some really good benefits and stay within that 150 to $200 a month, would you do business with me? Yes, I will. Okay, great. Affordable Care Act, ACA, helps them qualify for free health insurance if they're in certain parameters. That's pretty much it. So if the ACA says, hey, based on your income, based on how many dependents, how much this, how much that, you qualify for $600 from the government every month. So if that $600 makes their health insurance free, but they gave you a $150 to $200 a month budget, what can you now do with that $150 to $200? Right? Life insurance with living benefits, IULs for cash accumulation, hospital indemnity plans, dental plans, vision plans, all of those things pay in bulk. ACA doesn't pay a lot. ACA pays you maybe 15 to 20 bucks a month. It's not a lot, but all those supplements that you get to do is the clutch piece, right? So last open enrollment, for example, Howard enrolled close to 700 members. 700 members into ACA program. You know what it is to have 700 people to call, follow up on, cross-sell, a couple hospital indemnity options there. Some people use hospital indemnity to pay the deductibles. You're like, my health insurance has a $4,000 deductible, but if I stay in the hospital one day, that's $3,100. 2 days, that's another 600. There's the deductible money, right? Some people do that. Some people say, oh, I have health insurance, but I need dental and vision. Cool. So a dental and vision plan will pay you $150, $200, but it's quick, right? Some people are like, hey, I would love living benefits. Cancer, stroke, heart attack, accidental death benefit, foresters, bam, right? Or a Kansas City, instant issue $500,000 of term insurance with living benefits and ROP, like bam. I've sold IULs. I had a 24-year-old qualify for Affordable Care Act insurance, ACA. It was free. He had $200 a month worth of a budget. I was able to sell him an NLG IUL policy, because he liked the idea of cash value. Now, what started it, right? I first started with qualifying him for health. Then I presented the three types of insurances. I showed him the term, I showed him GUL, I showed him IUL. I showed him how any one of these products can have living benefits to help cover the medical expenses in the event that he goes to the hospital. I showed him how hospital indemnity will cover the first 90 days and how living benefits covers from 91 days forward. He said, I like it. I said, okay, great. Which one do you want to do? He says, I like the cash value. I said, oh, really? He says, yeah, if it has living benefits and it builds cash, I'm game. Let's do $200 a month there. Bam. And then hospital indemnity for him was like $60. So we ended up doing $260 a month, all from a health insurance lead, because I was able to get him free health insurance through the ACA program. Guys, it's clutch. It's clutch. It's clutch. It's clutch. It's clutch. I personally, I think I enrolled close to 32, 33, something like that, health insurance sales during the open enrollment period. But we wrote as an organization close to 100,000 in premium just on life side, not including hospital indemnity, not including dental and vision. We wrote about 100,000 just on the life side because of cross-selling, right? There was a time a long, long time ago. If you guys remember Wachovia Bank was one of my very, very first stomping grounds. It's when I had my license initially. And one of the things that bankers loved to sell was credit cards. You know what else it was? Automatic bill pay. Automatic bill pay and debit cards. Why do you think they love to sell these products? Think about it. Another debit, an extra debit card, automatic bill pay, or credit cards. Anybody want to give me an idea why bankers love to sell that? Why banks wanted bankers to sell that product?
They stay longer.
They stay longer. It becomes a sticky relationship, right? Look at Minor using my language there. It becomes a sticky client. You know what a sticky client is? Think about this. Think about you. You have a bank account and you got all your bills coming out of that same bank account automatically every single month. They're attached to your debit card, attached to your account number, routing number. Let's say that bank pisses you off. Excuse my French. They upset you. And you get an NSF fee. You know how much work you got to do to untether yourself from that bank? You know how much work you got to do to change all your bank accounts, change your automatic withdrawals, change your this, change your that, open up new accounts, wait for new checks, wait for new debit cards. Like it becomes so cumbersome that most people say, you know what, I'm just going to stay with the same bank. So they deal. So they deal with the NSF. They deal with the charges. They deal with it just because they're so tethered. They're so tethered to the bank. Well, if your clients are tethered to you because they've done hospital indemnity with you, health insurance with you, life insurance with you, credit repair with you, student loan forgiveness, that they're so tethered to you, right? You have a higher likelihood that client will stay and remain with you, because to untether themselves from you is a lot of work. To untether the relationship is a lot of work. They trust you with almost everything in their finances. So that's why you want to bring that stuff up. If you're licensed and you want to contract with us, reach out to Rob. If you're not licensed, you can send referrals over to Rob. Rob will take care of the client. Rob will give you the respect that you deserve in making sure if you don't want life insurance to be talked about, he won't. If you're okay with life insurance to be talked about, he'll solicit the life side and he'll put you on a split. So it's like free money coming to you for no work, right? But you have that relationship, you have that conversation with him. And if you're not licensed, you'll still get at least some type of a finder's fee referral commission for it. We could do that. You get what I'm saying? So this helps on all ends, guys. If you're not talking,
too.
I'm sorry.
I did want to mention states. States are important because people have referrals from all over the country and might not always be licensed in that state. We'll make sure to take care of that.
So let me show you something here real quick before we finish off. I got 7 minutes and then we're going to take lunch. Let me show you this here real quick. In our TKO website, you go right here. There's two places I want to show you. One, TKO territories. Right here, you're going to take a look at a map. This map shows you everywhere where TKO is currently selling. If it's in green, we're selling in it. We either have agents or clients in it. If you see this little stethoscope, that means we're selling health insurance there. So that's what Rob's talking about. If you send him a health insurance referral for Arkansas, we're not currently selling health insurance there, right? But we are selling in Utah. We are selling in Nevada. We are selling. Now, for my life people, if you're scared, you're like, oh my God, wait a minute. I got clients in Michigan. We have no problem getting our life licenses and selling here. Just let us know ahead of time. Tony, I'm about to write business in Maine. Cool. Let me know. Give me 2 days. I'll get the license over there. We can sell there together. No problem. It's not a problem, right? But these stethoscopes show you where we're currently selling health insurance. The dark green shows you where we're currently selling life. The light green shows you what we're currently pending. Okay, and I think that light green needs to be updated. I think it's already dark green, but this shows you that. From a health insurance side, you go right here to TKO Health Insurance. And what do you have here? Ready? Health contracting if you want to begin contracting, or if you want to send a referral. There it is. Boom, boom. If you want to send a referral, go right here. If you want to actually be contracted and become an agent, there it is right there. It's ready to go for you. Follow the steps. Sandra and I have nothing to do with health insurance contracting. Nothing to do. All we're going to do is refer you to Howard, refer you to Rob, refer you to Rob, refer you to Rob. That's all we're going to do. The last thing I want to show you is this. You'll like this. I encourage everybody to get one of these. You see this website? Look at the website, TonyMartinezFinance.com. You should all at some point invest and get your own personal websites created. Get your own, you know how many people say, well, send me something about you. Send them your personal website for that, especially if you're working leads. Especially if you're working leads. Let me tell you why I'm bringing this up now because of health insurance. I'll give you a tour of the website, but then I'll explain why why I bring this up during health insurance, right? So my graphics developer will build you a website like this, and she charges one time $250. She'll build it for you. Okay, so if you're interested in that, I need you to send me a notification. I'll have it. There's a form you'll fill out. You'll send her all of these pictures. You'll send her your bio, and she'll build you this website like this. Okay, this is what mine says, right? Insurance and savings are the tools by which we tell our family I love you even after we're gone. Here's a picture of me with a purse with a professional bio. Here's a picture of me socially with a personal bio. I'm humanizing myself. They're getting a chance to build rapport. There's more pictures of me with my dogs, pictures with my kids, right? Pictures of the things that I like. Like, look, I did a facial with my daughter there, right? There's pictures of my motorcycle. There's the things that I like to do, boating. I'm humanizing myself. Guys, I'm humanizing myself. This is super huge for leads. You know how many people worry with leads about hustles and scams? They don't know if you're here in the United States or in another country trying to hustle them, and you're about to ask them for financial information. This humanizes me. You know what else we do? We put a picture of your license. Here's my insurance license. What else do? We put a link to the state website if you can validate the license. I have my legal name, right? There's my legal name, Jose Antonio Martinez, because that's what they're going to look for online, not Tony Martinez. They're going to find Jose Antonio Martinez. I have my license number. I have it all there. You want to find me on social media? Look, here's all of my, where is it? Here's my social medias right there. So you can find me on Instagram, Facebook, LinkedIn. You can see my pages. Watch this. You go to services. Here's a list of all the services we offer. Come on now, come back to me. There it is. Man, look at all the services we offer. Life insurance, retirement planning, e-commerce, credit repair. Look at all the carriers that we sell. My contact info, my email, everything is there, right? Look at that. All that stuff is there. Testimonials. You got a couple clients you've helped out in the past, have them email you a testimony. Look, I got some testimonies. This is a client, Jackie B from Fort Myers. Here's another client, Araceli C from Illinois. Another client, Leslie T from Illinois. And then a testimony. You know how awesome it is to build rapport with your leads when they can see this stuff. But here's why I talk about from a health insurance side. Watch this. You click apply. You get a client that says, "Hey, I want dental insurance." Go right here. Apply yourself. I want health insurance. Go right here. Apply for yourself. They could do the application themselves in Spanish. Here it is. Short-term medical, you want to apply for short-term medical? Here it is. Apply yourself without me. Hospital indemnity plans. You know what's one of the things that's going to get out of here soon? Life insurance. We just partnered with a company called Ethos. Ethos, you guys will love it because everybody's going to get their own personal link where your client can click the link, can run their own quotes, and they can apply themselves without you even being there. And you get a full 9-month advance on the commissions. So we just got that relationship. I'm going to add that to this website here. So in case, you're in a rush, you don't want to sit with the client and do a fact finder, you want to speed your business up, boom, here's my website, check it out. Boom, here's my website, check it out. What's it cost you? $250 is what she charges you. Why is it so cheap? Because she's going to make a copy and paste of this one. That's what she's going to do. She's going to make a copy and paste of that, but with your pictures, your bios, your info. If you get creative and you want other things, she's got to charge you more because now she's going out of the box, right? And then you have to pay whatever the monthly hosting is of it. I think it's like $9 a month or something like that. If I'm not mistaken, the most recent one we just did, Lucia, do you mind if I show yours?
No, go ahead.
What's your website?
Lucia Vega Finance.
Oh, yeah.
Lucia Vega Finance. Look, so Lucia just had hers done. And look, see? Copy and paste. Right? She could change her intro if she wanted to. This is one that I use, but she liked this, so she's using it. But look, there's Lucia, there's her bio, there's her background, there's her professional bio, here's her personal bio. It's all her stuff. Here's some pictures she uploaded, testimonies.
Yeah.
right? Look, you can look at her license. I think somebody is unmuted. If my co-host can mute anybody who's unmuted, please. There's her license. You want to check her license out? Boom, there's the website to check her license out. If she has a Calendly link, schedule an appointment. If you have Calendly, boom, there it is. Clients can schedule appointments with you. An insurance needs analysis, a digital needs analysis, testimony. Look, her own personal testimonies. What did you think of creating bios? I would talk to somebody in your team and see if someone can make you a decent bio. That's what I would do. I don't know how to help you there, right? But it's all there, guys. You're a business. Be a business. When you schedule meetings, send people your website. Here's my website if you want to check me out, get a picture of who I am, little understanding of who I am. There it is, ready to go. 250, come on. My job, again, as a back office is to give you resources that you can use to build your platform, okay? Resources that you can use to build your agency, your brand, your name. This is solid for business development, for relationship creation. I mean, it's what you want to be leveraging, guys. How easy it is to send somebody a text message. Here's my website, check me out. You need to apply for health insurance? Boom, here's the link. You want to apply for life insurance? Boom, here's the link. You want to schedule an appointment with me? Boom, here's the website. Go to this, bam, there it is. You can schedule an appointment with me. We could do a Zoom meeting together. Cross-selling with credit repair, cross-selling with health insurance, building rapport, building your brand, your agency allows you to get into the real nitty-gritty stuff, which is what? Everybody wants to do a $250,000, $500,000 rollover. You think they're going to do it with somebody that doesn't have anything on the website to validate who you are as a business? You think they're going to do it with someone that doesn't have any experience in that world? We're giving you all the tools. You just got to be willing to walk down that path. Does anybody have any questions before I send everybody off to lunch? We are back. We're back from lunch. We're ready to get this bad boy going here. Okay, so let me tell you what's up next. A little bit behind schedule, but we'll be doing all right. I kind of anticipated some of that, so it's okay. We're doing for the next hour and a half, we're going to be doing case designing on an actual case. This is an actual case right now that we're working, just so you know. For confidentiality purposes, we're not disclosing the name of the client, but the case is actually a live client. And I'm going to show you how I would case design this. We're going to be doing that. And then right around, Yasmin, are you on? Are you on by chance? I see you there, right? Can you hear me?
Yes, sir. Can you hear me?
How long? Yes, I can. How long is your new associate training roughly? Like what time?
Typically like 40-ish minutes.
About 40 minutes?
Yes.
Okay, perfect. So do me a favor. In 40 minutes, can you unmute yourself and just let me know so that I could create that breakout room and move people over your way?
Okay, sounds good.
Okay, great. So first half, I want everybody on to just kind of see what it is that I would do. And then the second half, I'm gonna take new associates over to work with Yasmin. And to be quite frank, it's much more beneficial for you because if you don't understand what she's going to train you on, then the second half, when I start doing it, it's going to be completely over your head. You're not going to know anything at all that's going on. So it's beneficial that you have participated in that training. I have gotten some messages from the VPs as to who belongs where. I have Hopes. I have Hope Alliance there. I have their list of people, but if there's anybody else, LWA, any other agencies, VPs, SVPs, if you have specific people, have those names ready so I can move them over, okay? So let's get into it. So first, what I want to do is, let's go over the fact finder, okay? I'm going to verbally tell you, and what I want you guys to do is write this stuff down so you have the case in front of you. I'm not going to show the fact finder because then I'm afraid of disclosing some information that I don't want to disclose. But here's what I have on the person, okay? We've got an individual, a male. You've got a male who's, let me see here. Male, 3 children. Got a male, 3 children, generates, let's just say a 6-figure income, right? It's 75,000, okay? Wants to have an insurance and retirement conversation. That's what we learned in the fact finder. Wants to have an insurance and retirement conversation. Children are 9, 13, and 17. 9 and 13 are male, 17's female. This gentleman is, hang on one second. Hang on. This gentleman is 41 years of age, healthy, non-tobacco user. Okay. In my talk track, currently has $100,000 with a permanent insurance policy, $100,000 IUL. Okay, paying $100 a month into it. Those are all the things that we learned in the Fact Finder. The kind of position that they're in right now is in a position where, number one, he acknowledges that he needs more insurance coverage, but his main focus is cash accumulation. Main focus was cash accumulation. So although insurance is important, the amount, the cash accumulation side of it is important. So what I'm going to do, rather than making this a Q&A session, I'm going to just kind of tell you what my process is so you understand it. And then afterwards, if there's questions we can ask, right? My job in a fact finder is to figure out what matters to the client, number one. And then number two, make sure that I give a recommendation over the things that maybe they're not taking into consideration. What do I mean by that? Yes, cash accumulation is important. However, you've got a male with 3 children that are fairly young. Insurance has to be important as well too, right? However, because my first meeting was all focused on cash accumulation, it didn't make sense for me to do a dime analysis because that would have been more of an insurance conversation. I wanted to focus on the benefits of cash accumulation, which meant what? I spoke about the benefits of, hang on one second, what I got here. Okay, gotcha. I spoke about the benefits of, the IUL, right? If someone tells me cash accumulation is important, what am I going to talk about with the IUL? Tax-free return, how indexing works, the ability to tap into this money before 59 and a half, the fact that it's creditor protected, that's what I talk about. I didn't talk too much about the living benefits. I didn't talk too much about, the death benefit because that wasn't important. So my primary is always to focus on what's important to them. My secondary is to take care of the things that they might not necessarily have an eye on. So insurance is important, but it's still second on the list of importance, right? One of the questions that I always ask my clients is, listen, if you had to prioritize, what was most important to you? Is it cash accumulation? Is it death benefit or living benefit? How would you prioritize it? What order would you put that in? You'd be amazed how many people tell you, listen, living benefits to me is more important than death benefit and then cash accumulation. Or some people tell you cash accumulation is more important and then living benefits and then death benefit. Or some people might tell you death benefit. You got to figure out what matters to them. Because their job is to tell you the problem. Your job is to come up with a solution. Your job is not to tell them what the solution is. They have to, and then all of a sudden they agree to it. No, they got to give you the problem first before you can give them a solution. Right? Like math. 1 + 1 is 2. If I give you nothing but the number 2, you don't know what the problem is. If I just give you 2, you don't know if it's 10 - 8. You don't know. You don't know if it's 20 - 18. You don't know if it's 0 + 2. You don't know. If all I give you is the answer, you need to know the problem first in order to come up with the answer. Because the answer has to correlate, has to resonate to the problem, right? So when I spoke to this individual, the priority was cash accumulation, death benefit, and then living benefits. Cash accumulation, death benefit, living benefits. The moment they tell me cash accumulation, I know I'm dealing in the IUL space. But now, holy crap, which company do I select? There's so many companies to pick from, right? Cash accumulation, death benefit, and then living benefits. Well, let's think about it, right? NLG, they have all 3, but what are they really good at, right? Type it up on the box. Don't tell me, just type it. What's NLG known for? What are they really good at? Anybody? Let me see. What do we got? Living benefits. The best at living benefits. But wait, living benefits is this guy's 3rd on the list. Okay. They all have death benefit, so that's irrelevant. They all got death benefits, right? But this guy's main focus is cash accumulation. So wait a minute, which one, if you had to name off 2 companies that are the best at cash accumulation, they have a history, a record of that, what companies come to mind? Allianz, North American, that's right. They're not the best in living benefits, but they are the best in cash accumulation. See how great it is to be in the independent world? See how great it is to be a broker? You now can select different IUL companies based on the client's priorities. You know, if I was, watch this. If I was talking to a 50-year-old and he said to me, listen, death benefit is absolutely more important to me than cash value. Death benefit's absolutely more important to me than cash value. I'm not interested in growing my cash. I'm interested in death benefit legacy. What product are you thinking is the solution? There you go. Good job. There we go. There we go. A GUL. It makes sense. This guy doesn't care about cash accumulation. He cares about death benefit, and he wants to make sure that that it's a legacy. Someone says to me, "Listen, death benefit's important, but I'm on a tight budget." What are you suggesting? That's right, term insurance. You see, I never give the client my belief system towards any one of the products because every one of the products have a pro and a con. I need to know what matters to the client. So in my fact finder, I find out we got a 41-year-old male, healthy. 41 is a great age to still get involved into IUL. So I know that's still on the list. I know that his focus is cash accumulation. He wants to put money away. Here's something else that I did. I did a budget. Some of you guys don't do budgets and you don't realize how much you're missing out on. I did a budget on this individual. You know what I found out? Budget, there's about $1,100 left over every month. There's about $1,100 left over every single month after they pay all their bills. So ask yourself, does this candidate fit the model of an IUL? Of course they do. They have the discretionary income. He wants cash value. He's healthy. He's at a good age. This is a perfect candidate for IUL. You know what's something I always like to do as well too? I want to see what their savings patterns are. If you want to avoid chargebacks, when you know they have good discretionary income and you're about to recommend something that's more than $100 a month, what do you want to make sure you avoid? Chargebacks. So their pattern, their history will tell you if they're good savers. Watch this. I'll give you two scenarios, right? You do a budget on a client, he's got $1,100 left over every month. And you're like, hey, listen, are you a good saver? Yeah, where do you save money? Oh, I put money in my savings account. Cool, how long have you been doing it now for? I've been doing it for about 4 years, right? I've been doing it for about 4 years. Okay, good. So you got $1,100 left over every single month. You've been saving for about 4 years. How much are you putting away every single, what are you doing? I'm doing about $250 a month. Cool, how much do you have in your savings account? Well, I got $500. What are your thoughts? Go ahead, put it on the chat box. What are you thinking? Guy's got $1,100 left over every month. He says he's putting away $500 a month into savings. He's been doing it now for 3 years. But he's only got $500 in there. Maybe he has been for 3 years putting money in. But what he's not telling you is he's taking money out that next month. Yeah, I put the money in there, but 2 weeks later, man, I wanted to go on a date, so I used up the money. You're not a good saver, right? So when I met with this person, he said to me, I got $1,100, he didn't know what discretionary income he has, but he did tell me he puts away $250 a month. He's been doing it for about 3 years. So I did some math in my head. $250 a month by 12 months is $3,000. $3,000 for 3 years is about $9,000. I go, oh, so you got about $10,000 put away. You know what he tells me? I got about 12. What does that tell you? Is he a good saver? Is he responsible? Facts. I'm not so concerned now about recommending something over $250 a month. I'm not. So then we do a budget and we find out he's got $1,100 left over. He's like, oh, wow, I didn't realize that. I said, okay. Mr. Client, we've talked about how IULs work. We've talked about how indexing works. We've talked about, tax-free earnings. We've talked about 6 to 8% interest. We've talked about all that stuff. Mr. Client, if I could show you a product that can give you a tax-free return, access to money before retirement, make you an interest rate greater than inflation is currently charging at, without any market risk, what are you comfortable doing per month into something like this? That was my language. Well, you know what number he told me? About $500 a month. About 500. Why am I okay with that number? Because I know he's got $1,100 left over every month anyhow. And I know that he's been a decent saver already, so he'll probably be responsible. $500 a month on a 41-year-old, overfunded by about 40%. That's about 4,000 in target. You see how I'm putting the pieces together to the puzzle? I'm already kind of putting the piece, and I'm asking for permission. That way, when I come back to the closing meeting and I present him $500 a month, it's not a shock. No, he told me that number. He gave me permission. And how, as a business, I'm measuring him. How good of a stock is it to invest into you? That's how I look at all my clients. Are you a stock I want in my book of business? Or are you a stock that's going to fold and crumble? That's a chargeback. You do all the work to underwrite, to do this, to do the meetings, you pay your admin team, right? You build a reputation with the company because your persistency in your placements, and all of a sudden you lose the client. You're like, wait, what? That was a bad investment. That's a bad investment. As a business owner, I get to select my clients. So let me ask you guys a question. Based on the analysis I gave you, does this seem to be a good stock worth investing into? I'd say yeah, right? Young, healthy, decent saver, decent income, makes over 75,000, has something to lose, children, is responsible enough for the last 2 years been saving. Like, that is someone I want in my book of business. Now, if the situation would have been the same, except he wasn't a good saver, he doesn't know where the heck $1,100 a month has been going, he has no money saved, you think I'm going to recommend an IUL to this guy? Not at that number. I promise you I'm not. You are a bad stock worth investing into. You are not going to be anything more than maybe 2,000 in target premium. Maybe. Because the last thing you want to do, 6,000, 8,000 in target, all of a sudden that charges back. Company's calling you up, you got to pay that money back. Guys, in the independent world, if you don't pay your chargebacks back within typically a 60-day period, they'll terminate your contract and it rolls right up to the upline. I'm telling you now, you're in business to stay in business, y'all. You're in business to stay in business. I mean, nightmares I've been seeing doing, financial needs analysis right now on some existing agents. And you know what's 90% of their story they tell me? Well, I got this policy, this policy, this policy, this policy, and I got it on the last day of the month because we were going after a promotion, but I don't really know why I got it. Wait, what? No. Let's do right. Let's do right by ourselves. Let's do right by our clients. Let's do right, period. Let's do right. Let's do right. So this is the scenario that I got right now. So let me tell you what I'm thinking. He's giving me a $500 a month budget. My thoughts are his priority is cash value. So I'm always going to focus on cash value. I'm leaning on Allianz. Why am I leaning on Allianz? He makes more than 50,000. Allianz requires 50,000 minimum in income. Otherwise you cannot apply them with Allianz. He makes more than 50,000. He's healthy. He's young. Allianz is not the best in living benefits, but living benefits is third on his list. However, living benefits is important. So what am I going to try to present to him? I'm going to present to him an IUL from Allianz. I want him to take on a very small term policy with living benefits, because if it does happen, I want the living benefits to protect him for the next 30 years. Which company am I thinking about for living benefits? I'll tell you right now, term living benefits, Anico. You might say, well, why not NLG? NLG is costly. NLG likes to solicit 4 living benefits. Anico solicits 3 living benefits, but in those 3, the 4th one that NLG has is already embedded into the 3rd one with Anico. It's already embedded in there. So, it's the same. In my opinion, it's the same. But you could do NLG as well too. There's nothing wrong with that. It's just that I've noticed NLG is $15-20 more per month when I quote it. So I'd rather go Anico and stay cost effective. I'd rather, that's just me. My mind is thinking, okay, we're going in for, isn't it 55K a year? No, it's 50,000, Gerzo, 50K of income. 50K of income is the minimum requirements to get into an Allianz policy. You have to have residency status. ITIN is only going to be NLG, guys. Only going to be NLG. FNG is another opportunity, but I think up to 350,000 in coverage with FNG. And then NLG is the best for non-resident ITIN situations. So Allianz requires residency status, 50K of income. And the focus needs to be cash accumulation, not living benefit. When we're going living benefits, I'm going a different route. This guy's living benefits third. So again, back to my focus. I'm thinking Allianz as the solution, but secondary to that, I want to try to see if I can get him to get into a small term with living benefits. And is there one other thing I want to try to bring to his table? Is there one other thing? One other thing I'm going to try to bring to his table. Hospital indemnity. 100%. I'm going to try to do those 3 in my sale. Now, are there cross-selling opportunities in the future? Of course. You got kid IULs. You got 3 kids. right? I don't mind challenging him later on, probably on delivery. I don't know if I do it on the first close, but definitely on delivery. You know, 75 to 100 bucks a month per kid. I wouldn't. I'm not going to try to go after everything at once, though. You don't want to be that guy. Remember, you can create follow-up meetings. There's nothing wrong with that. Little by little, 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 right? Like right now, I'll tell you right now, for those of you, you know, Tony, where are you investing money? I'm investing money in IULs, businesses, and crypto, right? Like with crypto though, I do, you know, 500, 1,000 here, 500, 1,000 here, 500, 1,000 here, right? I looked at it yesterday and I'm like, holy crap, I put in a freaking big amount of money into this. Right now, I'm like, yo, this is better turn around. But would I have done that dollar amount all at once? No, but I did it in small increments. In small increments, I did, right? But would I have done that big number all at once? No way, no way. But in small increments, I can. So with sales, it's the same thing. I'm gonna try to get in first meeting. I'm gonna try to get Allianz, Anical Term, Hospital Indemnity. On delivery, I'm going to bring kid IULs. A little bit every time, a little bit every time, a little bit every time, right? On annual reviews, right? I'm going to try to see if we can sit down with fiance or spouse or whomever that may be at that time, right? Converting more term into more IUL, right? I'm going to, you know, there's always more that you might be able to do. There's always more you might be able to do, okay? Might sound crazy, but at some point I'd show him e-commerce. I would show him e-commerce if the objective was I need passive income now. And he has to have the liquidity to get into it. Guys, e-commerce means that the client has $25,000 to $40,000 now liquid, or $25,000 to $40,000 that they're willing to move out of an IRA for the purposes of getting into something that can give them passive income now. His goal wasn't passive income now. His goal is retirement later. So that's one reason I didn't bring it. But the second is he doesn't have the liquid lump sum money he needs to start an e-commerce opportunity.
Just to throw it in there, for me, it was not even necessarily so much that he's going to do it, but to get him excited about something, to start saving money. You know what I mean? To give, you know, because I know from my personal life, the reason why I used to always blow money is because I just had a short, you know, instant gratification mindset. You know, let me get this clothes or this car or whatever, you know, and give him something bigger to get excited about. Like, hey, let me give myself a real reason to start saving some money. I just want him to save some money. You know, whether it's e-commerce or not, you know.
Well, when you see my IUL, the way I present it, you'll understand as well too where their mindset goes. Because a lot of the way I design IULs is showing clients how every couple of years to increase your contribution and look at the return on it. Look at the return on it. But yes, you're 100% right. There's a lot of ways to get to Rome, right, Danny? So I respect that piece. I'm just kind of showing you how I would approach it, and then long term, how much other things I'm going to try to attach to that client relationship. So let me begin now with case design. Before I share the screen, I got to log in, and then I'll show you how I would design these policies. How much time do we got right now? Good, we got, all right, cool. We got 20 more minutes before we send new associates off. So let me first do the Heartland. Let me then do the term before I do the IUL. And I will be sharing the screen right now, guys. I just got to log in first. If you don't mind. Come on now, come on now, come on now. All right. There we go. All right. Share screen. Here we go. Let's see here. Oh, hang on a second. Sorry. Gotta find the fact finder again. I don't know exactly where I put it. There it is. Okay. Go back. All right, now I'll share screen. Great. Bam. All right. Give me a thumbs up if you guys can see the screen. Thumbs up, thumbs up, thumbs up from my peoples. Everybody, yeah, no, maybe. Okay, good. All right, good. All right, so let's do this. Then we're going to call this client, his name is John. Mr. John, Mr. John, Mr. John, Mr. John. Hang on 1 second. Date of birth is 10. I'll do it here. 10/24/1980. Let's go 600 all the way. Let's go 31 days of benefits. State in Illinois. Boom, 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 boom. Two applicants need to apply for it. Okay. Here we go. Let's run the quote. Look at this, $37.20. I'm gonna add the lump sum hospital confinement. So 1 day in the hospital, looking at $76. 1, 2, I'm gonna go with that one right there. Now, what I do, I'll tell you right now. There we go. What I'm gonna do is I'm gonna screenshot it because you can't like print out the illustration with hospital indemnity. I'm gonna screenshot it and I'm gonna upload it to my my OneNote, and I'll share with you guys my OneNote here momentarily as well. Let me see here. All right, so let me see here. Okay, so we did that. Next. Right, so we're looking at the hospital indemnity, $76. Right, was that the number we found, just to make sure? $76.70 for hospital indemnity, right? That covers that first 90 days, okay? And remember, the money pays out within, it's 31 days in the hospital, and then it pays out typically 30 days after you've sent in the invoice. So the next thing I'm gonna do, I'm gonna go to the TKO website. I'm gonna go to Mobile Quick Quotes. No, I'm sorry, not Mobile Quick Quotes. I'm sorry, Our IMO. Because for term quotes, it's honestly the very best quoting system to go right through our IMO's back office. I'm gonna go right here to Agent Portal, Agency Life Quotes. If you guys haven't seen this, you guys will love it. So again, let's put the client's name in. We got John, Jacob, right? I'm just making up somebody here. Let's see here, 10/24/1980. Male, non-tobacco, healthy, lives in Illinois. Right, he's got his height and weight. Let me see his height and weight. Where are you at? Height and weight is 5'11", 210 pounds. So he's super healthy. No pre-existing medical conditions. I'm going to run him at preferred. Now let's quote a 30-year term. Let's pick American National. Let's pick North American. Now let's just do a simple $500,000. Because again, we didn't do a dime analysis on this guy. He's not focused on death benefit. He's focused on cash value. However, it's not going to stop me from at least presenting something that should give him living benefits. Because let's face it, Allianz is going to be the best in cash accumulation, but it doesn't have critical illness. So I need to make sure that I at least bring to the table some type of term that offers critical illness. We'll put my information in. All right, put my number in. My license number in. You guys will like this a lot. Watch this. When you hit this button right here, run quote, bam, there it is. Instant quotes. 30-year term, you got $71 a month for North American, $76.46 for American National, right? Who's got the better living benefits of the two? Let me, a second. Where my people at? I see some questions popping up. If you aren't able to write Anico at this time, what would you recommend as the next option? I would recommend that you did North American. That's what I recommend you do. Okay, I recommend you do North America because North American has living benefits as well too. Okay. That's an awesome tool. All right, there we go. Let me look how cool that is right there, right? Now watch this. Let's say you wanted to look at GULs as well. So let's go right here to new quote, and let's add the GUL as well. Adding the GUL is, let's say, paid to age 100. Bam, paid to age 100. Same thing, 500. But you know what? Let's see about 750 as well. Let's just see what it looks like. Run quotes. There we go. So the first one is a 30-year term, 500, 500, and now look 750. 750 now gets you into 100, 112, 71. Remember, these are all ancillary sales. It's not the main objective. So I don't want to go digging deep into his pockets. I'm not going to try to bring in this 750. I was just doing this for training exercise. If it was a GUL, you go right here to age 100 and look at the GULs. Look at that. Right, 3, 4. Now you got an Advantage Gen. This one's the GUL to age 100. This one's the signature UL. Right? Again, I'm not going to present these because the reality is that's not his objective. I understand his number one priority is cash value, but I do want to talk to him as an insurance agent and make sure he understands, listen, for a little bit extra, I can at least protect you from chronic and critical illnesses as well. What do you think? Maybe he'll take it, maybe he won't, but it's worth bringing it to the table. I'm going to present, let me see here. I'm going to present North American because it's the most cost-effective solution. That's what I'm going to present, North American. It has living benefits. It has critical illness, chronic illness. The best one is American National, but again, it's not his priority. So because it's not his priority, it's third on his list. This is an ancillary, so I'd rather go the most cost-effective. So I'm going to go right here, North American. Let's just say though, however, I wanted to bring both to the table. Boom, 1, 2. Let's just say I wanted to let him choose. This one has better living benefits than that one, but it's an extra $5 more. You ready? Share. How do we want to share it to him? Do we want to download it? Do we want to email it to him through the system? Or do we want to text it to him? Let me text message it. Let's do a text message. Let's do a detailed comparison. And let's personalize our message to him. Let's say, thanks for lunch. See you next week. Here are some numbers to look at in the meantime. Now, on the chat box, no, I don't want to, let me see here, hang on a second. Let me do this, let me do this. All right, now I can. On the chat box, do me a favor, type up your numbers. Give me some numbers, I'm gonna send it over your way. Somebody type up your number, come on now. Yay, there we go, now they're coming through. 3, 5, 3. And as you get it, let me know that you got it. Hang on, don't give me too many numbers, y'all. One of them sent. You know, if you, one person already said they got it. Cool. Let me do a couple more. Let me see here. Let's go. Get texted. Let me know if the second person I just sent it to got it. Let's see here. I'm gonna do one more. And then I'll share the screen again and show you what it is. And bam, I just sent it to the third one. There it is. Now I'm going to share the screen again. Sometimes, for whatever reason, the text message doesn't go through. If the text message doesn't go through, here's what I always like to do. You hit view. When you view, this is what got sent to them. This is literally what just got sent to them. Here's what you can do. You can copy this hyperlink right click, copy, add it to your, save it on a note somewhere, and then you can present it later. Presentation, hang on. Presentation of term. Right click, paste. So I save it on my notes, right? I'll tell you what I will do for you guys is I'm going to add it in the chat box. So you guys can, if you want to, you can just click it right then and there and you'll see. I like to send it to the client and then I add it to one of my notes with a little bit of, information. So now I can go back. You can always go back to that link and open up your presentation. So notice how quickly we just did hospital indemnity. We just did the term. Those are the two ancillaries that you're going to do. You can also print it, to PDF, save it to PDF and email it. I mean, at the end of the day, you have a number of things you can do. Before I continue, any questions, type them up in the chat box, please, because I haven't even begun the IULs yet. Just out of curiosity. Everybody's good? Everybody's good? Everybody's good? Everybody's good? All right. All right. I like that. So we've got hospital indemnity we're going to bring to the table. We've got the term insurance. Remember, the term insurance is because of the living benefits. That's why we're going to bring it to the table. All right. Now, what's that? Giving other companies a run. Okay, gotcha. You're right, right? How do you share the indemnity quote? So with indemnity, they don't let you save it. So what I typically do is just screenshot the quote. Or obviously, if you're with the client in the virtual meeting, you open it up and show it on the screen. But I typically screenshot the quote. Okay. Now let me begin the IUL quote. Here's something I do with the IULs. Okay. Whenever I'm dealing with I don't do this every time, but if I'm dealing with $500 a month or higher, I will do this. I'm going to give the client three options, right? I'm going to give them $250 a month. I'm going to give them $500 a month. I'm going to give them $1,000 a month. Anybody know why I would do that?
So they can have more choice in what they want to do and they can see what their money will get them.
Which one do you think is the highest probability that they'll take?
The middle.
People will naturally, 90% of the times will go down the middle. Down the middle. Oh, I see what 250 does. I see what 500 does. I see what 1,000 does. You know what? Let me start at 250. Let me start at 500. They typically will go down the middle. They will. They'll typically go right down the middle. So now, this client's 40 years of age. They can afford 500. Let me show you how I figure out, okay, the formula, because I first got to figure out the target. This is the problem that a lot of agents have, is that they don't try to figure out the target first. They want to try to make everything target, but that's not, in my opinion, this is just my opinion, the right way to do it. My rules are simple. If you're 33 years or less, I don't mind running at that target. I don't. From 34 to 39, from 34 to 39, overfund by 30%. If you're in your 40s, overfund by 40%. If you're in your 50s, overfund by 50%. And if you're in your 60s, I don't know if this is going to be the right answer for you, but it just depends on how much you get. A 60-year-old doing something like this, they need to understand that it's going to be overfunded by a crap ton. I'm probably going to run it right at level. And the best they're going to get is maybe an ROP. I don't typically do this at all. I don't. But look how easy the rule is, right? Under 33 target, between 34 to 39, and you're overfund by 30%. If you're in your 40s, overfund by 40%. If you're in 50s, overfund by 50%. This client's 41 years old, so I'm overfunding by what percentage? 40%. That's right, 40%. Look at that. Look at that. Now watch. He can afford 500 per month. So if I'm overfunding by 40%, that means that the 60% needs to be the target, right? Because 60 plus 40 is 100. That's what you want to get to 100. I'm overfunding by 40%, so the 60% needs to be the target. So here's what I want to do. I'm going to take 500 and I'm going to multiply by 0.60. Right? 500 times 0.60 means my target is $300 a month. Take that, multiply by 12, which means what? The target for this policy needs to be $3,600. even though they're paying $500 a month. $500 a month times 12 is 6,000. So they're going to pay 6,000, but the target's going to be 3,600. This is how you overfund the policy the right way. Okay, you just want to stay close to this. For my technical people, does it have to be exactly that? No, chill, relax, take a breather, it's fine. Don't drown in a glass of water, okay? It's fine. You just want to be kind of close to that idea, close to that concept, right? So now let me share my screen, now that we know what we're looking for. We're looking for 3,600 target, 3,600 target. So I am in my illustration software. By the way, Allianz's illustration software is identical to NLG software. So let me pop this in. Birthday is 10/24/1980. Put these bad boys in there. Boom. Boom. 41-year-old male. Good. We're gonna make him preferred non-tobacco. Good. Okay. Notice it's gonna automatically default to 250,000. 250,000 gives me a target of 5,608. My target needs to be 3,600. So what do I need to do? Anybody know?
Lower. Or
That's right. I gotta lower the death benefit. So let's lower this bad boy to 125. 125 takes me to 2,800. Now I'm too low. Let's go back up. Let's go to 175. 175 takes me to 3,900. Let's go to 165. Takes me to 3,700. I'm okay with that number. That's pretty good. That's pretty close to 3,600. So it's a $165,000 policy, right? Let's pause for a moment here because I gotta create the other breakout room and take my new associates over. Sorry, you gotta get you moving. Gotta get you moving. So let me create this breakout room here. Hang on one second. I gotta go back to the message for Hope. Bam, there it is. Okay. Let me see here. I'm gonna assign manually. Let participants choose. Okay, create. Okay. What do we got here? Open all rooms. Open all rooms. Okay. All right. So. Oof, hang tight for a minute. I got a whole bunch of people here. Okay, here we go. I'm starting to assign you to rooms. And wait a second, hang on. Sorry, Yasmin. Let me give some proper introduction as well too. I'm gonna make Yasmin a co-host, otherwise it's gonna get stuck. Yasmin, co-host. So let me tell you a little bit about Yasmin Dominguez, guys. For those of you that are wondering where your newest associates are going, and if you are one of the newest associates, okay. So Yasmin Dominguez is my Chicago ride or die. Okay, she is a hustler among hustlers. She knows how to burn up that pen, knows how to write some strong business. Last year, she was one of my top personal producers. Okay, we're hoping to see if she takes that and becomes one of the biggest builders. But she's a beast. She's got more energy than anybody I've ever seen in my entire life. She can run on 2 hours of sleep and still act like she's doped up on freaking caffeine like no other. She's a great presenter, has an amazing personality. She's going to be teaching your newest associates about the fundamentals of insurance, the fundamentals of our back office. So do me a favor, on the chat box, give her some love because she's about to teach your newest guys how this bad boy works. Let me see here. Let me see. I'm gonna start assigning some people. I got one there. Let me grab the other. I don't know. So okay. Hang on a second. All right, we're back. We just sent our newest associates over to new associate training, and what's left is our veterans that are learning how to continue this case design. So we're doing the $500 a month first. So we're at 3,700 in target. 165 is what gives us 3,700. Here's what I do with the death benefit. I do this every time. I increase the death benefit from age 1 until age 70. Add. And then I make it level after that. I want the death benefit to increase only while the client is contributing. Nobody's going to pay into an IUL forever. They're going to stop making payments between 65 to 70 years of age. If they're adding more money, then the insurance has to increase. I want you to consider, let me kind of show you this analogy. I want you to consider a bucket. Pretend I'm holding a bucket right now. This bucket, you're putting water into it. This is a rhetorical question, but it's still an important question. How much water does the bucket hold? Anybody?
It only holds what you're showing us right now.
Yeah, so it can only hold as much water as the size of the bucket. The moment you put more water into the bucket than the bucket can hold, the water pours over. Okay, pouring over is MEC. You're putting too much money in, it becomes a modified endowment contract. So now, pretend the bucket is your life insurance death benefit, right? You're putting water into it. But if you want to increase your contributions, what do you need to tell your death benefit to do? Increase. Bigger the bucket, right? More water, more cash you can put into it, you can put into. But then when the client hits 65 and stops putting money into the bucket, so what do you tell the bucket to do? Okay, level off. You don't need to grow anymore. They're not putting any more money in, right? This prevents it from becoming a MEC and allows you to put more money in. It also gives the client the ability to keep the death benefit and the cash. If you level it and the client dies, the money that's in there stays with the insurance company and the client only gets the bucket, which is the face value. Does that make sense? Yeah. I'm not gonna lie, when somebody showed me that, I was like, oh my God, I totally get it now. Okay, maybe it's just me, I'm crazy like that. I get excited about stupid stuff. All right, here we go, let's keep going. So I'm increasing the death benefit until age 70, then I'm gonna level it off. Now, contributions, let's go to monthly pay. I'm not gonna run it at target, because if I run it at target, it'll only take 3,700. I wanna overfund because he's 40 years old. He's gotta play catch up. So we're gonna start at 500 a month. I'm gonna do that from policy year 1 until policy year 5, 5 years. Let's add, then, can you transfer, what? Into the breakout. Hang on a second, bro. I don't know if I can right now, to be honest with you, man. Sorry. Let me see here. Next one, 750. Let me see here. Then I'm going to increase by $250 from 500 to 750. I'm going to increase by 250 from year 6 to year 10. Then I'm going to increase from 750 to 1,000. You see how every 5 years we're increasing contributions. Let's go to year 15. Right? So now I'm 15 years in, he's 40, which means he's now 55. So let's increase again for another 5 years. Let's go to 1,250. And we'll go from year 16 to year 20. Now he's 60. Let's add one more. Go to 1,500. From year 21 until age 65. You put an A in front of the number, it becomes age 65. That's what I'm going to do. Every 5 years, we're showing an increase, showing an increase, showing an increase, showing an increase. I don't know if it'll hold it because we're already from the very beginning overfunded by 40%. But let's see what it does. Let's just look at it. We can always make adjustments after. The writing agent, boom, boom, boom. Let's look at the illustration. Nine. Okay. Let's see here. So let's look first at the illustration before I show you how I present the illustration. Let's see here. Non-guaranteed. Okay. All right. Notice this column here is the 500 a month. This is the contribution. So 6,000 a year, then 750, then 1,000 a month, then 15,000. Look what happens in year 19. Bam. It drops it to 14 and then 10 and then 10. What happened here? Anybody know what happened? Type it in the box. Tell me if you know what happened.
Did it level off?
No, it's not that it leveled off because look, his client's only 60 something years old. Remember, it levels off after the client finishes making payments. It's about to MEC. the system will prevent it from allowing it to become a mech. The system is basically saying, hey, you're putting too much money in this, man. If I let you put in that dollar amount, it's going to become a mech. Money's going to spill over. If money becomes if this policy becomes a mech, there's no turning back. And if it becomes a mech, it becomes fully taxable. So understand the term mech means taxable, and you want this money to be tax-free. So the system is saying, hey, don't put any more in. But I want to put more money in. So you know what I need to do? I need to increase the bucket from the beginning. I need to increase the target. Remember how I told you it might be too much because we're already overfunding by 40%. So because we are, what I'm going to do is this. I'm going to go back to the illustration. And I'm going to increase this target just a little bit. I'm going to go to 200,000. 200,000, my target goes to 4486. I'm still okay with it because there's increases that are going to be happening, right? But now that I've increased my bucket, it should hold that extra money. If my technical people are thinking, but now it's not overfunded by 40%, it's okay. It's fine. It's all good. Don't worry. Again, it's a baseline to start, and then you kind of adjust accordingly. Here we go. So let's see, does it hold it now? Am I sharing screens? Nod your head, right? You can see the screens? Yes? Okay. So $500 a month for 5 years, $750 a month for 5 years, $1,000 a month for 5 years, $1,250 a month for 5 years, right? $1,750 a month for 5 years. Actually, no, yep, there it is. Boom, for 5 years. $1,500 a month. I'm sorry, for 5 years. And then no more payments. It held it nicely. What happens on this 65th year, right? 300,000 has been put in, it's worth 540,000. Almost doubled the money. Almost doubled the money. It allowed for it to hold. Okay. So this is how I would present this. This is exactly how, now this is my 500. Okay. So here's what I'm going to do. I'm going to create a folder. Where you at, folder? Hang on 1 second. I'm going to create a folder so that it doesn't show. Okay, good. Nice, cool. All right, so I'm going to save this one. Let me save it. Let's go to Closers College. We'll save it there. All right, so we got valued client 5 Allianz 500 per month. There it is. So the next one that I'm going to do is 250 a month. Right? So let's do the math on 250 a month. Overfund by 40%, right? 250 times 0.60 means the target is going to be 150 a month. Times 12 means 1,800 is the target, even though the client's paying $3,000 a year. That's what I want. I want an $1,800 target, and it's probably going to go up a little bit because the contributions. The bucket needs to fit the increasing contributions. You guys can see my screen again? Yes, yes, yes. Thank you. All right, so let's get to 1,800. So let's drop this down to 100,000. 100,000 takes me to 2,200. 2,200, and guess what? That's the lowest that I can go. I can't go lower than that, because Allianz doesn't do IULs lower than 100,000. So 100,000 has to be the lowest. 2,200 is where I'm going to go, which is okay because that's probably where it would have ended up since I'm increasing contributions. The same death benefit format, increase until age 70 and then level off. Now what I got to do is adjust this. This is going to start at 250. And then this is going to go to 500. And then this one's going to go to 750. And then this one's going to go to 1,000. And then this one's going to go to 1,250. Now let's take a look at the presentation. Once you've done the first one, all the other ones are super easy. Guaranteed, non-guaranteed. All right, so here's $3,000, which is $250 a month for 5 years, $500 a month for 5 years, $750 a month for 5 years, and then look, it actually already maxed out. See that? It dropped it down, so it doesn't even hold that kind. You know what that means? You need to increase the plan a little bit. Let's take this to 125. 125 takes me to a target of 28. Okay. Let's run the illustration. If I was to sell him this, because it's coming so close to the target, there are 250s, $3,000. I would want to make sure that he understands he needs to put more money in every 5 years in order for this to work. If I see in his face that he's confident about it, I'm good with it. If not, I won't sell it to him that way. I'll actually reduce the death benefit down because I'll worry that he won't be able to put that much money in later. Here we go, $3,000, then $6,000, then $9,000, then 12. Something happened there. Look, it still doesn't allow him to put the remaining amount. It's just a lot of money. So I don't want to increase the target any longer. So what I am going to do then is I'm going to adjust the contributions. I'm going to put this at 1,100. We don't. The question, do I have to do increases of 250? I don't. I could do increases of $100 or $200 a month. It's just, I mean, I'm so robotic. I'm so systematic in my process because here's the biggest thing I tell the client when I meet with them and present this is that this is conceptual. I want you to conceptually understand how it works. And if this works, if you like the way it works, then how much do you want to put per month into it? But it doesn't have to be 250. You could do it in $200 increments. I might actually do it that way for this one. Yep, look, I have to do it like that way because look, it doesn't let me do it. Just too much money.
Coach, I'm not clear why we increasing. What's the reason for the increase? Is that just
because it's the right thing to do? These policies are designed for you to put more money in the future. If you're not increasing contributions in the policies, you're not maximizing its potential. It'd be like you coming to a Ferrari dealership and I tell you, listen, it's got 6 speeds, but you're only going to go to third gear. Right? You want to know, you might buy the Ferrari and never hit 6th gear, but you want to know that you can go to 6th gear. So here's something I want you guys to know. The client doesn't have to make the increases if they don't want to. They don't have to, right? But I want to show them what the potential of it is if they do put more money in. I want to show you what the potential is, right? So let's do the increases by 200 instead of by 250. So from 250 to go to 450, from 450 to go to 650, from 650 it'll go to 850. Then from 850 it'll go to what, 1,050. See if it holds it then. And again, I'm just showing you the way that I do it. You don't have to do it this way. This is just the way I've been doing it for several years now. It works for me. I know some people that they don't want to show the increases, and that's okay. I just personally don't believe you're showing them the capacity of what it can do.
Got it.
All right, here we go. Does it hold it? $3,000. Here we go. 250, 450, 550, 650, 750, and it held it all the way up until the very last year. It dropped it a little bit, but I'm going to be okay with that. I'm okay with that. Clients ends up putting in 194,000. There's 333,000 left over in gains. You see the return? 200 in, 333,000 out. That is a $137,000 gain in the product. This is the next one that I'm going to show him. By the way, for Allianz, if you want to know the target premium, it's going to be down here in the bottom right. See the T 2804? This is the target on there. Okay. Do you ever show it without the increases and with the increases? I do. So if here's the way that I typically do it. I'll present this, and if the client says to me, hey, can I see it level? Can I see it with no increases? I'll then run the illustration and show the increases. Okay. Would the illustration be better if you lowered the age of the death benefit to 70 to age 70 to 65? Can I put you back in the room? Wait, I'm confused here. Hang on a second. What do we got going on here? Who am I putting in? Okay, assigned to. There you go. I put you back in the room. All right, cool. Sorry. So no, the change of the death benefit won't make a difference because remember, we stopped the payments. We stopped the payments at 65. Even if you show the increases to age 70, it won't make a difference on the amount of cash going in. Okay, but this is what I would present for the 250 option. Now let's save it. Let's go again. Valued client. Come on now. Wake up. Why is this freezing up on me? Come on now. There we go. This is valued client to Allianz 250 per month. Now the last one, right? We did 250, we did 500. The last one is going to be at 1,000 a month. What's the question here? With increasing, the beneficiary gets the death benefit and the cash value. Then correct. If you don't increase it and you run it level, the beneficiary only gets the death benefit and the cash stays with the insurance company. That's pretty much almost like a whole life policy if you do it that way. So let's do the next one. The next one is 1,000 a month, right? So client's 40, overfund by 60%, 1,000 a month times 0.60, 600. 600 times 12 is 7,200 is my target, even though the client's paying 12,000 in. Okay, and again, we'll probably have to increase a little bit above that because we're showing increases, but you now know kind of where my starting point is. Let's look at it. So we need this target to be at 7,200. Let's take this to 400,000. 89. All right, let's take this to 350,000. 78. That's pretty close. We're starting the payments at 1,000 a month. Then we'll go to 1,250. Then we'll go to 1,500. Then we'll go to 1,750. Then we'll go to, I'm pretty certain this will MEC. I'm probably going to increase the death benefit. Let me bring this up to 425. Where's the target at? Target's 9,500, even though the client's paying 12,000, so I'm still okay with that. There's a level of overfunding already happening. You guys can see the illustration, right? Just want to make sure. Yes. Okay. Sometimes I forget to share. I'm here talking for like 20 minutes and be like, oh, we can't see it. I'm like, man, you should have told me when to begin. All right, so who we got? 12,000, 15,000, 18,000. So increases are going good. Increases are going good. Bam, it holds it perfectly. It holds it real nice. Client put in 450,000, it's worth 837,000. Do you see how in almost every scenario they double their money? And in every scenario, they almost double their money, That's good. For a 40-year-old to be able to double his money is perfect. A 30-year-old should triple his money. A 20-year-old should quintuple his money. You see how that works? Boom, 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 boom. Right? But this is what I'm going to show. The likelihood of my client doing this is very slim because we know their budget is $1,100 left over every month. I would make it super tight, but I got to show them what they can work themselves to do. So we're showing 250, we're showing 500, we're showing 1,000. Somewhere in the middle is where more than likely the client's going to go. Now, let me show you how I present this. Because all I'm going to really do, I'm going to present, actually, let me save this one. I'll show you. I would present the middle one first, just so you know. Value client, Allianz, 1,000 a month. There we go. Good. Okay. So let me now do this. When I present it, let me show you how I present it. I guess in the past, most agents do the level out to age 121. Paid up appears to be kind of sexier. I don't understand that question. I don't like to run it at level because you're not giving the client the opportunity to gain both the cash and the death benefit. And I also don't like showing payments continuing to pay after 65, 70 years of age because it's unrealistic. Can the illustration look really sexy if the client keeps making payments until 121? Yes, but it's unrealistic. I mean, you mean to tell me, I look at that illustration, I'm like, Mr. Client, are you prepared to continue to make payments until you hit 100? No, I don't want to make payments until I'm 100. Well, what age do you want to stop making payments? Oh, I want to stop at 65 or 70. Okay, well, let me show you what this does in a realistic scenario, right? My screen being shared? Yes, 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 and yes. Okay, good. All right, so let me show you how I present this illustration. Number one, Mr. Client, we have a 41-year-old male. You're healthy. The biggest thing I want you to understand in this presentation is that this is conceptual. I want to see if you can conceptually understand how this works. If you conceptually understand how this works, you can then decide how much you actually want to put in. So the numbers I'm showing you here today, you're able to up these numbers, decrease these numbers, or do exactly what I'm showing you. But the whole goal today is for you to conceptually understand how they work. Okay, good. So let me explain to you a little bit about this company. Number one, Mr. Client. Let me talk to you a little bit about how indexing works. Let me talk a little bit about the stability of this company. We're picking two indexes, Mr. Client. The first index is the Bloomberg index. We're putting 50% of your money there. Second index is the PIMCO index. We're putting 50% of your money there. I want you to know something. Allianz as a company, let me share with you a little bit about the company. Is an A-rated company, A+, A+. These are third-party rating companies. Standard & Poor's, AM Best, and Moody's. Allianz is one of the best companies in the market. As a matter of fact, for this particular product, they are the #1 cash accumulating product in the market space, according to Forbes magazine, for about a decade now. Those indexes that I'm showing you are proprietary. Other companies that want them cannot have them, because Allianz essentially created these types of indexes. Now, let me tell you a little bit about the history of these indexes. And hang on one second. So, I did a presentation a couple of days ago and I was incorrect on something, and I think they're on here now, so I'll show them. Okay, so this one right here is invested into the classic allocation. The classic allocation, okay, it's got a 125% participation. You know what 125% means? It means that if the market makes 10%, you'll make 12.5. You're gonna get 125% of the market. Now, if the market goes down to the negatives, you're not gonna lose anything. Mr. Klein, I want you to know in the last 10 years, these have performed at, one of these index has performed at 7.85, the other index has performed at 6.68. In the last 15 years, the Bloomberg has performed at 7.18 and the PIMCO has performed at 6.89%. So you're dealing with a very, very strong index. The numbers that I'm going to show you today are based on a 6.15% rate. I'm not giving you a high number like 7.18. I'm not going to give you a low number like 2 and 3%. I'm going to show you a very conservative approach to this type of portfolio. Okay. Now for agents, pause for a minute. Like let's say I'm not talking to the client right now. I'm talking to you guys, agents. You might look at these and be like, wait, there's 145 here. There's 140 here. Well, what's the difference? This one has a 1% asset charge, right? So there's a 1% fee here. I'm not a big fan of fees. That's why I don't typically show this one, okay? This one has a 15% multiplier. I'm not a big fan of this one either. This is the typical one that I'm going because it also gives them a guaranteed of 0.9%. So in the years that the market doesn't perform, in this particular index here, they'll still get a 0.9% floor guarantee. But here's my advice to you all. Don't take my word for it. Contact Allianz and talk to their sales division and ask them about these indexes. Ask them about it so you understand how they all work. Okay, this one has an option to move it into a guaranteed environment. This one has a 4%, has a 0% floor, but it's got a 15% multiplier on it. Okay, so let me see where these are. This one is invested into. Let's see here. Let's see. Let's look at the indexes. I'll show that next in a second. We're running these at an illustration rate of 6.15. Okay, 6.15 is what we're going to be running this at. If you notice, the minimum that this is done is 3.9 on any given year. The maximum this is done is 7.64. There's what we're running at 6.15. This has been the historical performance of this particular product. Right? So what does this mean? Watch. The market did 6.12%, you get paid 7.65. In 2006, the market did 6.12, we paid the client 7.625. Why? Because it's 125%. On this year, the market did 8%, so we paid the client 10.2%. On this year, the market did -1, we didn't pay the client anything, the client didn't lose anything. On this year, the market did -0.6, we didn't pay the client anything. So you don't lose money when the market goes down, but you gain money when the market goes up. If you look at the average, 7.85 over a 10-year period, 7.18 over a 15-year period. Mr. Klein, if you would have done business with me in 2005 and you would have gone all the way through for 15 years, this is the return you would have made on all your money. This is on the Bloomberg. This one is on the PIMCO. So I'm showing you the history of both of these indexes. Okay. Now, let me explain to you something that this particular company has. In the negative years, why isn't it? Because you have to switch it to that. You have a 0.9 floor that you can move it to. You have to actually manually move it into that. Okay. I want to show you this rate lock over here. Okay. Do we run a product, a noted rate, lower rate under the promise? No, I don't understand that question. I run it at the illustrations average rate limitation. 6.15 is what it is what this is. And that meets guidelines. So now let me show you what this rate lock here means. And here's how I present rate lock, and then I'll show it to you over here. Something you guys are going to love. Auto rate lock is something that no other IUL company has. People need to understand how indexes credit. This is time. This is money. If the index starts at the beginning of the year here and ends here, that's a positive index, right? It's a positive index. If the index starts here and ends here, that's a negative index. This is a positive index, this is a negative index. So let's just say this right here is 100. And then let me put some dotted lines to represent that mark right here. Let's say this is 108. Or I'm sorry, that's a little bit too aggressive. I'm sorry. Let's say that's 106. 100 to 106 is a 6% increase. So the client makes 6%, 125% of 6%. Okay. If the index ends up here, which is let's call this 94%, right? that is a decrease. That's a negative 6%. So the client gets a 0% return. Does that make sense how indexing works? Yes, 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 and yes. I can't see yes. Okay. Okay, great. Now, if you notice, it does not matter what happened in the middle. What mattered is what happened here, which is day 1, and what happened here in day 365. What happens between day 2 and day 364 doesn't matter. It's just what happened here, what happened here. The index could have done this and ended up here. Or it could have done this and ended up here. It doesn't matter in a traditional index what happens between day 2 and day 364. It only matters where it started and where it ended. Positive, negative. What if you could put a rate lock where you tell the IUL, if you ever hit 110 at any time of the year, lock me in at that rate. Lock me in at that rate. Holy crap. You know what that means? That means that every day now matters. Every day now matters. With most IULs, it's only day 1 and day 365. Doesn't matter what happens in the middle. Does not matter. With Allianz's auto rate lock, every day now matters. Because an auto rate lock means you could be aggressive. You could say, hey, listen, I'm going to put this at 110. I'm going to put this at 112. I'm going to put this at 115, whatever. If at any time, any day at all, it hits that number, just one day, you're going to get that for that year. Even if it ends up as a negative index. Even if it ends up as a positive index, you're going to get that. You're going to get that, you're going to get that. Now, why do you want to be aggressive with your rate lock? Let's say you're conservative with your rate lock. You put your rate lock at 105, but the market ends up over here at 107. You're not going to get 107, you're going to get 105. If you're conservative with your rate lock, you could lose out. If you're aggressive with your rate lock, you could really bank. If it never hits this number, like you set it to 110 and it never hits it, the index kind of brushes right over it at 109 and ends up here, then you're just going to get this. You're just going to get whatever it started at, whatever it ended at. But because you didn't hit your lock, it won't lock there. Does that make sense? Guys, that's a killer feature, and there's no additional cost to that. You automatically set it. When you set it, they're locked in for that year. They can't make changes until the very next year. But this is huge. This is why this has been the #1 performing IUL in the market space, because now all 365 days matter. It's not just day 1 to day 365. It's, man, if any time in the day it hits a crazy number, I'm locked in for that year. I'm locked in for that year. I'm locked in for that year. Does that make sense? Yes, 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 and yes. That's got to be sexy. That has to be, if that doesn't make your toes curl, this industry is just not for you, yo. That's ridiculous, okay? So this is what the illustration shows, right? Illustration says, listen, right? If the market started here and it ended here, notice that's a positive growth. If you set a rate lock at 108, you're going to get 108. But in retrospect, year 2, if you set the rate lock at 108 again, and the market starts here at 102 and ends at 112, because you set the rate lock too conservative at 108, you're going to get the 108 when you could have gotten the 112. So this is how it can work for you. This is how it can work against you. I present this here and then show this here, because this tells the story. The dry erase board tells the story a little bit better than, in my opinion, what this does here. Right? Okay. Yes, the illustration and NA is a lot easier to read than some other carriers. Okay. Okay, so now let's jump right to the actual illustration. Mr. Client, conceptually, I just want you to understand how this bad boy works. If you can understand conceptually how it works, we are in a good place. So here's what I'm going to do. Let's see here. What do we got here? Without password, your permission. Let me see here. I don't have the password for that. That's frustrating. 4. Okay. Yeah, there's a reason why I'm doing it this way, so you guys see. Okay. And can I zoom in a little bit? Come on, man. Let me zoom in a bit. Let me zoom in a bit. Right there, right there. Killing me, Smalls. Making me look bad. That's pretty close. All right, good. All right, so I'll put a couple things here. Right here, we'll put dollar signs. Right here, I'm gonna write the word benefit. Right here, I'm gonna write the word quit. And right here, I'm gonna write the word live. Okay. You got dollar signs, live, quit, benefit. Every one of these columns represents what I just wrote above there. It's a lot easier to understand it this way. This represents your contributions. That's why the dollar signs are here. Mr. Klein, this is a $200,000 policy. You got a 41-year-old male, preferred non-tobacco. This represents your contributions, this column. Now, again, I just want you to conceptually understand how this works. This is you showing you doing $500 a month every year for a 5-year period. And then after 5 years, you make an elective decision. You're not required to, but you just electively choose to do it. And you say, hey, I want to go from 500 to 750. And you do that for 5 years. And then on the 11th year, you say, I want to do 1,000. So this column represents your contributions. Okay. This column to the right here represents your benefit, which is your insurance money. How do you get access to this money? You get access to this money 2 ways. One, if you pass away. If you pass away, your family's going to get whatever number is here. Now, if you become chronically ill, where you need a nurse to take care of you, you need a nurse to take care of you because you can't dress yourself, feed yourself, bathe yourself, or something in that nature, you can actually use a portion of this money to pay for that nurse to take care of you, or you can pay a family member to take care of you so that family member could pay their bills while they're taking care of you, but it's there. That's what this benefit section here represents. This column here represents what happens if you quit. If you say, Tony, I'm done with this relationship, give me my money, I want out. And this column here represents your cash. If you don't quit on us and you trust us long term, this should represent the cash that you're going to be able to grow and tap into on a tax-free basis. Mr. Klein, do you agree with me that investing is like a seesaw? To get something, you got to give something, right? So these are long-term strategies. So the benefit you're going to get in these strategies, number one, is this: tax-free growth. Your interest rates, what is this? Tax-free growth, right? Interest rates that are higher than inflation at 5, 6, 7% type strategies. What just happened here? Can everybody hear me?
We can hear you.
Can everybody see the screen?
Yeah.
We can hear and see you fine.
Okay, perfect.
Yeah, I got a power bump on my end.
Okay, so you're gonna get all of that, right? The benefit is you get tax-free growth, you get interest rates at 6, 7%. Oh,
Turn the light on over there, see what happens.
Irvin, I gotta mute you, bud. You're distracting me right now. There we go. And you get the ability to tap into this money before retirement without having to worry about penalties. You're gonna get creditor protection as well too. You can't be sued, garnished, or levied. That's what you're getting. What are you giving up? You're giving up short-term access. You're giving up 100%, you're giving up short-term access. Okay? So if you want short-term access to be your pro, if you want it to be the pro, then you got to give up everything that I just talked about. You got to give up tax-free money. You got to give up creditor protection. You got to give up 6 to 7% earnings. You got to give all that stuff up, right? So why am I saying it this way? I'm saying it to you because this is not very attractive on the front end. Look what happens on the front end. Mr. Client, you pay $500 the first year, every month, that's $6,000. You've only got $4,200 left in your cash value. This is a live column. And if you quit, you know how much I'm giving you? I'm not giving you anything. Zero. Now your insurance, however, it went up. I mean, look, we started with 200,000 in insurance and now it went up to 204,000. Why did it go up? It went up because we're giving you, Mr. Client, the 200,000 plus the cash. Whatever cash you have here on any given year, if you add 200,000 to it, that turns into the death benefit or the benefit you could tap into for critical illnesses. So right here, when you see it at 224, that's 200,000 plus the 24,432 that you have in cash value. That's why it turns into 224,432. Mr. Client, do you see how short-term this is? Not an investment you want to go into. It's actually not an investment at all in the first 5-10 years. I mean, you go in for 5 years and you would have put in 30 grand. You've only got 24,000 that you've accumulated. And if you quit, I'm only giving you $17,000. I mean, you lost money. I'm looking at you square in the face, Mr. Client, and I'm telling you, this is not a short-term investment. It's not. 10 years out. In 10 years, you've put in 75,000. Guess what? You've got 75,672. Woo! You've got back the money that you put in, but if you quit, I'm still only writing you a check for 72, so you lost. You see how it's not really a short-term vehicle? Here's where it becomes attractive. It's the long-term side of business, the long-term side of this operation. Watch this. 15 years in, Mr. Client, you're 56 years of age. You're still not retired. You would have put in 135,000. You now have 166,000 sitting in cash value. And if you quit, look, I'm giving you same dollar amount. I'm giving you same dollar amount. Why is that? Because you've now paid the cost of insurance and now you're building more cash than what the cost is of doing business with this company, Allianz. You now own this type of death benefit. So if you needed this because you passed away, 366,000 to your family. If you needed this because you became medically ill, 366,000 that you can use to pay for nursing expenses. If you needed 166,000 to invest into a secondary property, an investment property, another, something you want to flip a home or whatever, you have that money that you can tap into, but it's still not doing the maximum potential because this is a long-term vehicle. 20 years out, you put in 210,000, it's now worth 315. I've literally doubled your money. I'm sorry, I've made you a 50% return on your money. 210 in, 315 out, and it's tax-free, by the way, Mr. Client. You're 60, you're still not retired though. 65 hits. At 65 years of age, Mr. Client, you would have put in 300,000. Look what it's worth, 540,000. I've almost doubled your money. You put in 300,000. It made you 240,000 tax-free. If you quit, Mr. Client, I'm giving you the full 540,000. If you passed away, your family gets 400. Your family gets 740,000. This is tax-free that you can tap into. If you draw out of this money, but keep your relationship with us, it's tax-free as well. If you quit and you say, give me my money, I don't want the insurance, this money is now taxable, just so you understand. This is a tax-free environment as long as you have a relationship with the insurance company. The moment you quit your relationship with the insurance company, this money becomes taxable. Not all of it, but at least the earnings, the 240,000 will be. Now, Mr. Client, let me ask you a question. 65 comes along. Notice, after 65, you're not putting any more money in. You're done. You're done, set it, forget it. What just happened? I just did something that I didn't want to do. Hang on one second. Sorry. The view, I don't want it to be in that view. Let me zoom in again. Did that, there it is, okay. I'm gonna do that. View continuous, continuous scroll, view hide sidebar, there we go. What did I do? Sorry guys, hang on. I usually do this on my iPad, which is a lot easier, but that's why this became a little complex. So Mr. Client, you're not putting any more money in afterwards. You're done. Let me ask you a question, Mr. Client. When you retire, and I want everybody to answer this question in the chat box, okay? Mr. Client, when you retire, are you going to be getting rid of your most aggressive investments first or your most conservative investments first? Go ahead and answer that question. Most aggressive. That's right. Most aggressive. That's right. Why? Mr. Client, why? Why would you be getting rid of your most aggressive investments first? YOLO. Why would you get rid of your most aggressive investments first? You can't afford to lose. That's right. Limit my liability. Correct. You're too old to take on risk. Exactly. Mr. Client, would you agree when you hit 65 and you finally retire, you're probably going to tap into your 401ks. You're going to probably tap into your IRAs. You're going to tap into anything that's aggressive, your stock portfolio. Okay. You're going to tap into all of that stuff first, which means this money is going to do what? It's going to sit. It's going to grow. It's going to continue to grow. It's not going to be the first place you tap into money. Even though you stopped making payments at 65, you stop making payments at 65. Look, 65 is the last year you make any payments, right? 65 is the last year you make any payments, and then no more, no more, no more. You probably won't tap into this until you hit about 70. At 70, Mr. Client, you'd have $703,000. So if you think about it, at 65, you had $540,000. But by letting it sit another 5 more years, now you have $700,000 out of a $300,000 investment that you can draw out tax-free. At 70, when you've liquidated your IRAs, your 401ks and everything, and you have this as an asset, notice every single year you went from 703 to 750. That's $47,000 worth of interest. You could take out the interest and live off that tax-free if you wanted to. You could take out the interest and live off that tax-free if you wanted to. Mr. Client, would you like, or let me ask you this question. Do you have an investment right now that's going to offer you tax-free money on the back end? Do you have an asset right now that'll give you the ability to take money out tax-free, where if Uncle Sam decided to increase taxes, he could not tap into this money? Because here's the reality, $47,000 worth of earnings, let's just say 50,000 for the sake of it, is the same thing as making $80,000 a year if it were taxable. But it's not taxable, it's tax-free. It's net in your pocket. Net in your pocket. Does this make sense? Is this something that you want? Is this something that you could see added to your portfolio that would bring value to your portfolio? Does that make sense? Let's do this for a quick minute. Let's take a break and come right back. Man, you guys missed a bunch here. That was a good locker room conversation. So what I'm getting at is this, guys. When I present, guy gave me $500 a month. I'm going to show him $250. I'm going to show him $500. I'm going to show him $1,000. The detailed presentation that I just gave right now, I'll do it on one of them. And I want to see how he responds. How does that number look to you? If he says to me, man, I really like that, I'll say, well, look, can you do 1,000? If he says, yes, I bring the 1,000. If he says, I like it, but I don't know if I can, well, can you do 250? Yeah, I can do 250. Then I'll show the 250. But I'm not gonna put him through 250, 500. I'm not. I'm gonna show the 500 and see how he responds. If he's like, I love it, this is exactly what I want to do, why am I gonna show the other two? If he says, it's a little bit steep, then I'll show the 250. If he says, I love the 500, but I want to do more, then I'll show the 1,000. But I gotta let him or her tell me how they feel about the middle ground number that I showed. And when I show the other ones, I'm not gonna do every single line. I'm gonna go, here's 10 years, here's 15 years, here's 20 years, here's how it looks. Here's 10 years, here's 15 years, here's 20 years, here's how it looks. Either one that you do, Mr. Client, it's not going to be a short-term solution, but it will be a long-term solution. It will be there for you for the long term, no matter, right? As long as you're there for me, I'm there for you, kind of conversation. But Mr. Client, I think we do need to do this though. I think we need to consider the fact that this is only being funded by your number one asset, and that's your ability to earn a living. Would you agree, Mr. Client? Yes. Your ability to earn a living is so stinking important to you. I mean, Mr. Client, we're putting together a plan. We're putting together a plan that's going to be there for you at 65. Mr. Client, you, my friend, are 41. This plan requires you to make plans requiring you to make 24 years of payments so that by 65, you can draw an income out. And let's say it'll last you until the age of 90. If something happens along this way with your income, this is out the window. Mr. Client, just bear with me for a minute here. You're about to put $500 a month here. And you're not insuring your ability to put this $500 a month. Have you ever heard of a hospital indemnity plan? And have you ever heard of living benefits? Hospital indemnity plan, Mr. Client's going to run you about $73 a month. Living benefits is going to run you about $75 a month. Right? Let me make sure I got those numbers right. Hang on a second, because I would have honestly prepped for this before I had the meeting, but because we're doing it right now. Hang on one second. Hospital indemnity. Come on, where are you?
76,
Was it 70, 77, right? So 70, okay, so hospital indemnity. 77. And then the living benefits.
7128.
7128. Okay, so $72. I go, Mr. Client, your income is your biggest asset that you have. And without that income, you have no way of funding this plan. And without being able to fund this plan, you won't be able to successfully retire on a tax-free basis. So what I'm proposing to you is this. Let's ensure your retirement. Let's turn your paycheck into a playcheck for you. Here's what I'm saying. A hospital indemnity plan says if you end up in the hospital for any medical reason or any physical reason, so it could be injury or it could be sickness. If you end up in the hospital, this hospital indemnity plan, if you're in the hospital for 30 days, will pay you $21,000. If you're in the hospital for 1 day, we'll pay you $3,100. If you're in the hospital for day 2, day 3, day 4, day 5, we'll pay you $600 a day. But the total amount is roughly $21,000 if you're in the hospital for 30 days. Cash in your hands. Mr. Klein, how much does it take for you to pay your bills every month? About $6,000? Right? Okay. So if you end up in a hospital for 30 days, you're going to get $21,000. That'll help pay month 1. It'll help pay month 2. It'll help pay month 3. Right? Why do I say month 1, month 2, month 3? Because on month 3, you have a living benefit policy that'll give you access to several $100,000. And that costs you about $72 a month. And that's 70. And this living benefit, just so you know, it's about $500,000 worth of coverage. It'll be there for 30 years of your life. So if something happens to you at any point in time in these next 30 years, which look, you got 24 years to put money away. If something happens to you in the next 24 years or 30 years of your life, because you're spending 77 here, because you're spending 72 here, you know your $500 a month is protected, your living expenses are protected, your family is protected, your ability to pay the bills is protected, your ability to make your copay on your health insurance is protected. Mr. Klein, do you know how much your copay is on your health insurance? Oh, it's $6,000. Would you mind if this policy paid for your copay out of the $21,000 in cash and then gave you the rest in cash? Would that upset you? No, I would love that. So I understand you could do $500 a month. Do you mind if instead of 500, we did 650? 500 towards your savings, 77 towards this, 72 towards that. You know what most people will say? They'll be like, you know what? I'll do at least this. And so they end up doing this and this. Some people will say, you know what? Let me do all three. Some people will say, you know what? No, I'm good. I just want to do the 500. Either case, if you don't present, you have no chance. You give them an opportunity to say no to you. Give them an opportunity to say no to you. Notice when I talked about the living benefits, I didn't say life insurance. That was third on his list. You get what I'm saying? His interest was cash accumulation, living benefit. Boom, here it is. Here's your answers. Any questions? Type them up in the chat box. Let me see here real quick. Boom, boom, boom. I was trying to. we get technical here now, participation loans and everything. Okay, I know there are fees on taking participation loan, but I was concerning about getting access to this lump sum money and the charge it gets access. After I learn how to explain this, you will most likely set up business with me. Okay, good stuff. Good stuff. Question was, I was trying to explain participation loans to a client. How can we explain the security of taking loans for a person with lump sum money to set up his policy? You know, when I explain loans, I explain it like a pension. That's the way I do it. Mr. Client, when you hit retirement, you're earning about $50,000 in interest. You can borrow out if you need to, $50,000, and it's pretty much tax-free. You're taking a loan out on your death benefit. That's what you're doing. You're taking a loan out on your death benefit. And so they don't mind giving you the loan because they know you're good for it, because when you pass away, they're going to pay off the loan and give the remaining balance to your family. So this policy here shows that you've got about $700,000 in cash accumulation. You could probably borrow about 90% of that. Not all at once, but you know, over a 20, 30-year period, you can borrow against it, right? That loan will accumulate interest, about a 5% interest, but when you pass away, they're going to use your death benefit. That's about $900,000 to pay off that loan and give the remaining amount to your family. So you get to take out close to $700,000. You get to leave to your family about $100,000. Your money's tax-free. The money to your family's tax-free. So 700 plus their 100 is about 800,000 on what? On a $200,000 or $300,000 investment. Was it worth it? Right? So, but here's what I will say to my technical people: stop. Just stop. Honestly, stop. My technical people, you guys need to understand something. You are an anomaly. You are 1 in 100, right? I'm not trying to cater to the 1. I'm trying to cater to the 99. I promise you this. In the 18 years I've been in this industry, the types of questions that you guys are asking me only get asked to me during trainings like this. Now, one of my clients, maybe one, and I've got thousands of clients, have gone that deep as you guys have done. You guys want to find the nitty. Listen, understand something that you need to just accept it. 2 out of 50 states provide a financial education. A lot of people don't know how money works. They don't understand the rules of the money game. And I'm not saying to mislead them. I'm educating you on how these things work. And I'm being more specific with you than I would a client. But just understand, when I'm in a client meeting, I'm not going to get this in depth. Because if they get confused, if they feel lost, they'd rather not do anything. If you overcomplicate, guys, I promise you they would rather not do anything at all. And here's another thing I'm going to tell you. And I say this to you for your own peace of mind. If you're dealing with people that are asking you those types of questions, then change your market. Sorry. That's my answer for you. Change your market. You got to know who to cater to. And I'm just saying, you, my personality, I'm not a technical, I can get technical. Notice you guys are asking me technical questions, I'm answering them to you. Here's the reason, here's the rhyme, here's the why. But if I had to live a world where every single day I was gonna have to get this much into the trenches, what? If I had hair, I would have lost it. If I had hair, I would have lost it. So why do I say that? I'm intentional about who my market is. You know who I love working with? I love working with lawyers. I love working with small business owners. I love working with people that work for the government, the school system. You know who I don't like working with? Engineers, accountants. You know why? Because they love to get technical. I mean, that is paralysis by analysis heaven. I'm not telling you that they don't deserve to be helped. If your personality is for it, great. Mine's not. Mine's just not. So when you're thinking to yourself, well, what about this? What about this? Honestly, you know, when you guys ask me technical questions like that, I ask myself, who in the hell is even asking them that question? And who? My client's not asking me that. So who in the right mind is asking them these questions? 90% of y'all are coming up with the question yourself because you're trying to find the leak. If you're going to try to find the leak, you'll find it. This is not a perfect product. I'm telling you guys right now, it's not a perfect product, but there's no such thing as a perfect product. I'm going to repeat it. There's no such thing as a perfect product. The moment someone creates a perfect product, we're all out of business. If you create a perfect product, I promise you someone will find a way sell it electronically online. You better be the person that finds a way to do it because we're all out of business. There's no such thing as a perfect product. There's no perfect stock. There's no perfect money market. There's no perfect savings. There's no perfect bond. There's no perfect. I can find something that does something better. You probably could. But you know, I'm not telling you that you need to do everything over here. What I'm telling you is, do you have the time to find that thing that'll do better? And how much is it going to cost you to find that thing that'll do better? Do you even know what that thing that'll do better is? Because is there anybody knocking on your door right now trying to give you some financial literacy? I think I'm the only guy right now knocking. If I'm competing against somebody, let me know. But if I'm not competing against anybody and you're already giving me a hard time, are you in your own way right now? Are you in your own way? And if you are in your own way, that's okay. Let me know. That's okay. Call me when you're ready. I'm all right with that. Does that make sense?